Welcome to the most comprehensive, beginner-friendly trading masterclass on the internet. What I've done is I've taken over 5 years of my best coaching material and I've meticulously compiled it into a 4+ hour training where I'm going to take you as a beginner trader through the basics and from A to Z give you everything that you need to know to turn trading into a full-time career. So let's talk about setting up a broker account and finding a platform to trade on. Now, if you're outside of the US, I have alternatives, but let's cover the broker and the platform that I'm currently using to trade on inside of the US. Now, this section, brokers, platforms, is over inside the Discord server, okay, under mentorship group. And that is where you will have the links to these options that I'm about to go over. Now, Charles Schwab is the broker that I use to trade on. Charles Schwab allows you to create what is called a custodial account. So if you're under 18, I know Charles Schwab is a great option. Charles Schwab also allows you to trade with what is called a paper account. Paper money is essentially simulated fake capital. So you can get into real live market conditions without putting any of your own money on the line. And then in addition, you can also get approved for various levels of options trading on Charles Schwab. I'm not sponsored or endorsed by them, but it is the broker that I would recommend because they have very fast fill times. Avoid Robinhood, okay? Robinhood is a broker and platform in one. However, Robinhood is not the move. They have awful fill times. You will struggle a lot to trade, and they don't even have charts, okay? You can't do any technical analysis whatsoever. Now, as far as the platform I use to trade on, well, I use ThinkorSwim. So when you create an account on Schwab, you will then download ThinkorSwim and you will log in with your credentials into ThinkorSwim. Now, ThinkorSwim is the platform that you're going to see in all of the videos moving forward in this curriculum and in all of the screenshots over inside the Discord server. Now, if you are trading outside of the US, you need the ability to be able to trade options. So interactive brokers is what I would recommend. Interactive brokers is going to allow you to trade options. You're going to learn obviously what options are, how options work, how to actually trade options moving forward, but just know that you have to be approved to trade options on both Charles Schwab and on interactive brokers to then be able to utilize the full system that you're going to learn. Now, as far as the platform that I would use to trade on, so when it comes to all of your technical analysis, again, everything that I'm going to be teaching you over the coming videos, well, I would recommend TradingView. Now, TradingView is a trading platform that does link to interactive brokers. And that way you'll be able to follow along in this curriculum and be able to use the same tools and have access to the same moving averages, different time frames, and everything that you are going to need to utilize the system that you are about to learn. So just to recap, if you're inside the US, Charles Schwab is the broker that I would recommend using, and then that pairs with the ThinkorSwim trading platform. And then if you're outside of the US, interactive brokers is the brokerage I would recommend creating an account on. And then as far as the trading platform that you're going to use that will pair with interactive brokers, well, that will be TradingView. Now, if you open up these links, this first link, Charles Schwab, is just going to take you to their homepage where you're then going to go and open an account. Now, real quick, if you go click on open an account, you're going to want to open an individual brokerage account, okay? Now, as you're going about setting up your Charles Schwab account, what I need you to do when it asks you, would you like to make this a margin account? You want to hit no, okay? You do not want to make this a margin account. Now, why are you going about not making this a margin account? Well, there's what is called the PDT rule. That means that if you have less than $25,000, you are limited to only taking 3 day trades within a 5-day trading period. Now, by saying no to a margin account, you will be put on a cash account. Now, a cash account means that you have no limit to how many day trades you can take. However, you have to trade with settled cash. Now, what that means is that if you have $1,000 in your account and you go about buying $1,000 worth of a stock and selling that today, and then you want to go buy another $1,000 worth of another stock, you're going to have to wait overnight until the next trading day to then have that $1,000 or whatever the equivalent is, whether you lost or made money, worth of buying power to then go trade with. So this will not be an issue because we are going to be swing trading. That is the strategy that you're going to be learning as I swing trade 100% of the time. So again, you want to just hit no You would not like a margin account. That is going to give you a cash account. Then there is no limit to how much money you need in your brokerage account, and you will not be limited to only taking 3 day trades within a 5-day trading period. Now, under options trading, what you need to do is hit yes. You would like to add this feature. Again, you need to make sure that you have the ability to trade options. Now, this goes on interactive brokers. Make sure to choose the option that is going to allow you to trade options. Now, lastly, on Schwab, you're going to be presented with this question. Would you like to enable this account for trading on ThinkorSwim? You're going to hit yes. Now, finish filling out your account info and you will be all set. And next, you want to make sure that you download ThinkorSwim. Okay, so just download the ThinkorSwim desktop and mobile version so you can have it on both your phone and computer. Moving forward in all the videos, I will be using ThinkorSwim desktop. Okay. But it's also very handy to have it on your phone as well. So again, just click login to download and then log in to get the app. And then you're going to use your Charles Schwab login and go ahead and download ThinkorSwim. And then you can go about logging into the TOS. Now, once you have your interactive brokers account set up, click on Trading View. Okay, and this page is going to tell you how to go about connecting interactive brokers to the Trading View platform. All right, so at this point, you should have your broker set up, whether that is Charles Schwab or Interactive Brokers. You should have downloaded ThinkorSwim, and you should have connected your Interactive Brokers to your TradingView account, okay? Now, what we're gonna do is cover how I have gone about setting up my ThinkorSwim platform in the next video. In addition to that, we're gonna make sure that if you are on TradingView, you will have access to the same tools needed to follow along throughout the curriculum. So go ahead, move on to the next video. So now that you have a broker set up, whether that is Charles Schwab or Interactive Brokers, which were my 2 recommendations in the previous video, now that you are approved for options trading and you've downloaded your ThinkorSwim desktop platform or you've created an account on TradingView, we are ready to go. So I'm going to cover how to go about setting up your ThinkorSwim platform. I'm going to give you my template so you can have the exact same setup that I have. And then over on TradingView, I'm going to make sure that you have access to the same tools that you will need moving forward. So first, let's cover how to set up your ThinkorSwim platform. And if you're on TradingView, then just skip toward the end of this video and you can watch how to go about setting up your TradingView platform. If you've already got your ThinkorSwim set up and your TradingView set up, then you're more than welcome to move on to the next video. So when you first open your ThinkorSwim account, it is going to look like this. So kind of the first thing we want to do here is just go to this little icon right here. We're going to click on one screen, and then down here, active trader, we're going to remove that. And then these are kind of the buttons to zoom in and out. You're going to get more familiar, don't worry, as you go with ThinkorSwim. All of this on the left, trader, TV, live news. We're just going to click on the gadget, delete gadget, okay, delete gadget. And what I'm doing is I'm essentially just trying to clean it up a bit here, okay? So I always say that simpler is better. You'll see we'll just make this a lot more simplified. Now, these are watch lists. You've got one watch list here. We can go ahead, click the plus. We can add another watch list. Now, you've got your default watch list. What I want you to do is go up to this little icon, change the color to red, and then under your watch list, right next to it here, change this to red and do the same for this one. Okay, so we've got red, red. Now, anytime you click on a stock, it is going to change on your main screen here. Now, if you click on default, you've got personal, and then what I've done is I've gone about adding my watch lists. Now, what you can do to create your own watch list is just click on default, go down to create watch list, and the 2 watch lists I use are going to be 2023 watch list, okay? Go ahead and hit save. Since I already have one, it won't let me save it. And then the second watch list, you're gonna obviously just go back and do that one more time. So default, create watch list, open positions. So I'm just gonna be using that 2023 watch list in open positions. If you go to personal, you can see 2023 watch list and then personal, open positions. So super easy. Under account info, there's gonna be all of your account information, how much money you have in your account, how much buying power, how much option buying power. Now I am on a margin account because I do have over 25,000 in my account. So yours is going to look a little different there. So under trade, this is where we're going to be doing all of our charting and technical analysis. Now, what I'm going to want you to do is go over to this little chart settings, click on time axis, and then add 180 to the right. So 180 bars to the right, click on apply, and now it's going to give you some space over here. So it's going to be a little bit easier to do our TA, our technical analysis. Okay, go back to this little gear icon. Now let's go over to appearance. I like clicking on fill up. That's going to fill in all of the green candles. I like removing the grid, and I don't like this little volume graph under here. So what I'm going to do is I'm going to go to equities, and I'm going to click on the volume, show volume subgraph, and uncheck that. Now I'm going to click apply, and there you go. We just cleaned up our chart. Now, when it comes to time frames, I'm going to be doing all my work on the 4-hour time frame. So we'll go over to the 4-hour there. Now, this is what your screen should look like at this point. What you want to then go do is click on this little edit studies, and I want you to go to studies and type in simple. You're going to want to click on the simple moving average and click on add selected, and then click on add selected again. So we want 2 simple moving averages. And then what I want you to do is go ahead and type in exponential. Okay, so EXPO, so moving average exponential. You're going to hit add selected. We want one of those. Now we're going to go to this little gear icon, and this is going to be the first simple moving average. We're going to change the length to 180, go to color, and I'm going to have this set as green. I'd recommend you use the same colors so it's congruent with all of the videos moving forward. Back to the gear icon. Now we're going to click on length, change the second simple moving average to 50, color, red. And then finally, the moving average exponential, click on the gear icon, change this length to 15, and then leave it as the default blue color. And now you're going to click apply, and there you go. We have what are called moving averages on our screen. I'm going to talk about what moving averages are. I'm going to talk about time frames. I just want to make sure that your platform is set up exactly as mine is. So we've got monitor, trade, analyze, scan, market watch, charts, tools, education, and help. The only tabs I'm going to be using are going to be monitor, trade, and analyze. Now, as we progress through in the curriculum, you're going to learn more about what each one of these mean. Okay, but for now, this is all we need. We've got our ThinkorSwim platform set up. We've got our 3 moving averages. Okay, we've got the 180-day SMA, which is green. We've got the 50-day SMA, which is red. And we've got the 15-day EMA, which is blue. We've got our 2 watch lists set up, and we're on the 4-hour time frame, looking back over the last 180 days. So each candlestick represents 4 hours of time. And if we zoom all the way out here, we can see back 180 days. Now, the only 2 tools that we're really going to be utilizing under drawing tools are going to be the trend line. Now, the trend line essentially just lets you click on an area of a chart and then drag. So you're able to essentially see the percentage on a chart. So let's say I go down to this area at 409.21, I click, and then I drag this drawing tool up here to 451.76. Well, we can see that is 10% off of this area. So you click and drag, and you can see the percentages on a chart. Now, the second tool under drawing tools is going to be price level. Price level, all you have to do is click, and then it is going to give you this line right here. So these lines we're going to use for support and resistance. Now, if you right click on the line, edit properties, go down here to style, yours is going to look something like this. Okay. But what I like is this white one. So again, right click, edit properties, change style to the dotted line, change the color to white, change the width to 2. Now you have the same trend line I have. Awesome. Now, if you head over to the Discord server under mentorship, brokers and platforms, you can see my ThinkorSwim layout, which is downloadable. All you have to do is click on that layout and then click view in ThinkorSwim. Open ThinkorSwim, and then look what is going to happen. And then now if you go up to setup, under setup, you should see the daily traders TOS layout. Okay, click on that and click OK. And there you go. So that's pretty easy. So now let's head over to TradingView. So if you're going to be trading on TradingView, I need you to follow the next steps so we can make sure that your TradingView is set up just as my ThinkorSwim is set up. So then you're going to have no issue following along in the curriculum. So go up to this little toggle right here, hit new layout. I just want to make sure we're all on the same page. Now I've got the S&P 500 pulled up. Okay, so SPY, I just typed in SPY. Doesn't matter what you're looking at here. But first thing we want to do is click on the time frame. Make sure that we are on the 4-hour, okay, and then scroll down here and change the minutes to days and click on this little option and then type in 180. So 180 days 4-hour ad. Great. Now we're looking on the 4-hour time frame, and we can see back over the last 180 days. Pretty nice, right? So that is exactly how I've got my ThinkorSwim set up. Now, if you click here, hollow candles is not the option we want. We just want normal candles. Okay, so there we go. Candles all set. So, TradingView isn't my favorite, but that is still all right. You will still be able to do everything I do on here. Now we want to apply our moving averages. So if we just click on indicators, okay, we then type in simple, we should see moving average simple. Okay, so click on that once, click on that twice. Now we've got our 2 SMAs, and then we want our exponential moving average. Just type in expo and you can see moving average exponential. Just click that once. And now we want to go and edit these. So one of them we want to be 180. It's going to be a moving average. That is good. Okay, good. Visibility, good. Now let's go to style and change the color to green. Okay, again, I want this to be as similar to my ThinkorSwim as possible. And now head over to the next SMA. This is going to be the 50-day SMA. Okay, 50 style, change that to red. Nice. Okay. And then lastly, the EMA. This is going to be the 15-day EMA. All right. Then I will leave the color default to blue. Now, when it comes to drawing our trend lines, just click on this little icon trend line, and then there you go. You're able to draw out those support and resistance lines we will need. It is fully up to you however you want to customize TradingView. But beyond this, you've got the 3 moving averages that we do need, and you should be looking on the 4-hour candle over the last 180 days. Okay, just make sure to add that. Make sure that is 180 days indeed, and then you will be set. So that is it. It's pretty straightforward to set up TradingView. Whatever stock you want to look at, again, we want to make sure we have our 2 SMAs, the 180-day, which is green, the 50-day SMA, which is red, and then the 15-day EMA, which is blue. We're on the 4-hour time frame, and we are all set. I will go ahead. I will copy a link. And I've gone ahead and pasted it right here. Again, brokers platforms, TradingView layout, downloadable. Just click on that. And then you'll have the same layout on your TradingView as I do on my ThinkorSwim. So at this point, you should be ready to go. You've got your broker set up and you've got your trading platform set up. All right, you can go ahead and move on to the next lesson. Now, if you guys are taking away any knowledge or value so far in this 4-hour free masterclass, I did want to quickly mention that I did open up enrollment for seats inside my mentorship group. That's right. I'm taking on students to work with me personally. Now, every single morning, I'm trading live in front of you on the market. You're going to have access to watch myself trade, to follow along, and copy myself if you so desire. I'll put a link in the description below. You can check out my mentorship. You can see what is included, and I hope to see you over there. All right, in this lesson, we're going to be talking about moving averages, what moving averages I use to trade. Now, essentially what I'm doing is I am trying to identify patterns within larger time frames. So I do almost all of my work on the 4-hour time frame. Within this 4-hour time frame, these are the moving averages that work for me. Now, if you were to switch, say go to a 30-minute, go to a 1-hour, the strategies that I'm going to teach as far as, finding these setups and finding these patterns within these larger time frames, well, these moving averages aren't going to interact exactly how they would, for example, on the 4 hours. So there's a very specific way to go about using these moving averages, and it has to be done on a specific time frame to work. Or not necessarily to work, but for the purpose of, what I do and how I find my trades and how I go about trading and watching candlestick movement and seeing how candles interact within these different moving averages. Well, that all has to do with the time frame and the exact moving average. So I use 3 moving averages, okay? I use the 15-day EMA. Now, these are common moving averages. You've probably heard of them before, but the way in which I go about using these moving averages is what is important. Now, some people think that you just apply these moving averages onto your chart and you pretty much just look and say, well, the price is trading above the 180-day SMA. I might as well go long, right? People just go with the lowest common denominator and think about the simplest formula, when really what you have to do is look a step or several steps closer and further examine into really understanding how these moving averages, they're not only just telling you, okay, the price is trading above the 180-day SMA, but you have to look and see how the price and the candles are reacting. Now, depending on what platform you're using, you're going to need the simple moving average, okay, and the exponential moving average. You can pull these up on TradingView or whatever platform you use for charting. You're going to want to add simple moving average, exponential moving average, and then simple moving average, okay? Now, the first simple moving average is going to be the 180-day SMA. So SMA stands for simple moving average. Now, I like to change the color and make it green. So the length is going to be 180 and the color is going to be green. And again, that is the simple moving average. And then we're going to want to go ahead and apply the moving average exponential, or the exponential moving average, the EMA. So you're going to want to go ahead and type in 15 for the length, and I like to make the color blue. You can change these colors, but it might get confusing. So you're better off to go with the same colors that I use. Lastly, we're going to apply another simple moving average, but for this one, we're going to change the length to 50. So I use the 50-day SMA, and I like to make that red. So we're going to go ahead and click OK, and then of course just apply, and you're now going to be able to see these lines. Okay, we've got the green line, that is the 180-day SMA, the red line, that is the 50-day SMA, and then the blue line, which is the 15-day EMA. Now, later on in the course, you're going to see how I go about really using these moving averages to find these setups and to find these patterns within this time frame, specifically the 4-hour time frame. Most people just use moving averages as an indicator. And what I mean by that is they're going to look and see that, well, if we're trading above the 180-day SMA, that must be bullish. Okay, overall direction is in our favor. And while that is true, we have to look even closer. Now, what I do is I focus on price movement, and I want to see how buyers and sellers are reacting and interacting within these levels. So we're not just looking at a line on a chart and saying it's at or above this level, that means it's bearish or bullish. We want to see how the candles themselves are interacting and how the price movement is changing. Like I said, it's more than just looking at these levels and seeing whether we're above or below them. We want to actually see how buyers and sellers are interacting within these levels. And there's multiple ways you can go about looking at this, but one of the most simple ways to explain what I mean is, let's say we look at the 15-day EMA. We lost the 15-day EMA. We sold off. We started trading below. We broke up above the 15-day EMA. We made a high, broke back below. Okay. And now we just made a break above. Everyone's looking at the same chart. So we want to think about what they are looking at and almost do the opposite. So if they're waiting for a break above the 15-day EMA for confirmation, well, we want to be ahead of the curve. We want to get in, before that happens. You have to be ahead of where everyone else is going to be. So instead of waiting for all your indicators to align and waiting for confirmation, well, you should be entering before confirmation. And once you get confirmation, that's when you're actually selling. Once everyone else has waited for their 30 indicators to align and has gotten confirmation, that is when you should be locking in profits and selling. Now, breaking this down even further, I am not using a moving average as an indicator or, a line to tell me whether price is bullish or bearish, or even what direction we should be playing price movement. Okay, this is kind of a hard concept to grasp, but you want to think in the perspective of every other trader out there, because like I said, everyone has access to these same moving averages you do. So try to think, well, what is the most, common strategy that people are going to be using? Well, they're going to be looking for confirmation. Now, I've seen multiple traders say, okay, wait for a confirmation. Well, by the time you've gotten confirmation, the move has already happened, okay? The move has happened once you've gotten confirmation. You're too late once you have gotten confirmation. Honestly, anyone who tells you wait for confirmation in such a basic way doesn't know what they're talking about, because once you wait for that confirmation, the other 1 million, 2 million, 3 million traders who are watching this same chart with these same moving averages just got confirmation at the same time you did. Well, what do you think is going to happen to the price? Again, it's important to realize there's always going to be an exception to the rule, but what you want to start doing is start thinking of moving averages less in the way of just a line that is going to tell you whether direction is bullish or bearish and what way you should be playing the price. Instead, try to look at these moving averages and think where buyers and sellers are going to be reacting. And that is almost a third eye, if you will, to looking at the market, to using these indicators that everyone has access to, yet very few people know how to actually use properly. Okay? Very, very important lesson. Please watch this video again. Please take notes. And now you're going to have to go ahead and apply this to your own trading and continue working and expanding upon this idea. All right, that's it for this lesson. You can go ahead and move on to the next one. Now, I want you to think of support as a floor. Price pulls back to that floor and bounces off of it. Now, on the other hand, think of resistance as being a ceiling. Price pushes up to that level, up to that ceiling, and is rejected and comes back down. This resistance above hand is going to act as a barrier, okay? And this support below us, all right, below where we're currently trading, is going to act as a floor. So let's hop inside my chart and I'm going to give you some real life examples to show you exactly what I mean. Now, based on the time frame that you are trading on, there will be different support and resistance levels. If you don't know what a time frame is, when we're looking at a chart, well, what we can see here are called candles. Each candle represents a certain amount of time. For this example, I am currently on the 1 minute time frame, where each candle we can see represents 1 minute of time. And if I go over here to say a 4-hour candle, where each candlestick represents 4 hours of time, there will be visually different areas where we can see a floor, our support level, or we can see a ceiling, our resistance level. Know that based off of the way you go about trading, you will be trading on different time frames. Now, the higher the time frame, okay, the stronger that support or resistance level will be. So daily support and resistance levels formed on a 1 minute time frame, for example, you can see the 1 minute here, are not going to hold as strong as a support or resistance on a higher time frame than, say, the 4-hour, which we're currently looking at. Now, how do we go about actually marking our support or resistance levels on a chart? Let me show you. So here you can see ticker symbol AAPL, which is Apple. Now, if we look at this chart, I am on the 4-hour time frame, looking back over the past 180 days. This is the time frame that I do all of my trading on. Okay, so any trades I'm taking, I'm looking at this 4-hour, 180-day chart. We can see we have an all-time low and an all-time high. Think of our all-time low as being this big level of support on our chart, whereas that all-time high is going to be that big level of resistance. But when we look at where we're currently trading on Apple, okay, we're trading at $171.10. Now, what we're going to see is support on a pullback and resistance on a push. So we're going to be charting out the highs and the lows on this chart. Okay, so let's look at the immediate term here. Okay, we're looking at the immediate, what I'd call trend. Now, in this immediate trend, we can see, okay, we got this very large push. Price ended up topping out at 182.35. Now, this area is going to be our resistance. Now you can see the top of a candle, which is called a wick, is going to represent where this chart has faced an area of resistance. Okay, so this 180 to 35 is going to act as resistance. And you're probably asking, okay, why didn't you draw a resistance level here? Or say here? Well, that is because we can see price has moved past these areas, okay, 179.70, which was previously acting as resistance. We broke above that area and then traded up to our next previous resistance at 180.83. So now these two levels have been invalidated as resistance, and we've got our new resistance level at 182.35. Now, when it comes to support, and while still looking at the immediate trend here on the 4-hour, well, let's try to identify our support levels. We can see, all right, we had a pullback here. You can see this wick on the 4-hour candle touching this 167.61 area. So we'll go ahead and draw our support level right there. Now you can see we ended up pushing higher, saw another small pullback. There'll be a little support there, okay, at 169.27. And then we saw another push. We're gonna start to see smaller support levels. So when looking at the bigger picture, it is important to be aware of what I call key support and resistance levels. And I'd say our key support levels on this chart are gonna be sitting at 167.61, 169.27, and 169.92. All right, these are the significant pullbacks that we've seen. Now, why am I not drawing support up here? Well, you can see that we have pulled back and we have invalidated any previous support levels. So in the immediate term, looking forward, okay, well, this is gonna be our next area of support that we will approach. If we break this 169.92 area, well then 169.27 is gonna be our next support, followed by 167.61. Now, if we head over to the 1 minute time frame, we can see within the day, we will have faced many smaller minor support and resistance levels. That's why when you're trading a chart and based off of the way you're going about trading your strategy, you just need to be aware of the key support and resistance levels on a larger time frame. So even if you are day trading on a 1 minute, it is still more helpful than not to know about a key area of support or resistance on, say, the 4-hour or the daily time frame. Now, on a 1 minute time frame, we can go about charting out our resistance. So we had what I'd call our daily resistance level here, okay, at this looks just to be about 173.07 area. You can see off the open, we ended up pulling back a bit and then started forming higher highs, pushing up to 173.07, forming resistance. Now, throughout this trading day, we wanted to keep an eye and be aware of this overhead resistance level. But it looks like the market did end up pulling back and we started selling off. Okay, seeing lower lows throughout the day. And then we ended up closing the day. Well, our daily low would have been sitting here, okay, at 170.65. The lowest price that Apple traded on the day is our support, and the highest price that Apple traded on the day was our resistance. That's what a daily support or resistance area is. So far, we've gone over what is a support level, what is a resistance level. We've talked about time frames, and we've talked about actually marking our chart at where these support and resistance levels are. How to go about identifying either a support or a resistance level, which we will continue working on. But I wanted to talk about the fact that the more tests of that either support or resistance area, that is going to further validate that level on the chart. And I'll show you what I mean by that. Okay, so on CPT, I'm looking back in June, but just for an example here, you can see we ended up hitting an area of resistance, okay, at 114.04. We pulled back and then we ended up testing this 114.04 area of resistance again And then we were rejected and then continued selling off. So that just means we had 2 tests of this resistance level. And each time we test either a support or a resistance, it is going to further validate how strong that area is going to be or is going to act. So when it comes to my trading, I'm setting my trade plan based around a support or a resistance area. So I'm figuring out where that support is and where that resistance is, and based off whether I am long on a chart, which means I'm betting on that stock to go up, or based off of whether I am short on a chart, which means I'm betting on that stock to go down, well, then that support or resistance level is going to be the area at which, if broken, I will either be getting out of my trade for a win or getting out of my trade for a loss. And like I said, I'll give you some live examples of this later on, but let me show you a couple more charts where we have seen multiple tests of either a support or resistance level. Now, here is another example where we can see a low, an all-time low at 174.06. Again, we're on the 4-hour time frame looking back over the last 180 days. And then you can see we pushed off this area, okay, found some resistance, ended up pulling back, forming lower lows, and then you could see price pulled back, and we had another test of this same area at 174.06, and then we got a nice bounce off that level. So you can see tested, and then we ended up testing again. We found our floor, we moved off that level, and then this chart even tried a third time, but couldn't end up breaking this all-time low. Okay, so 3 tests of the support level, further confirmation that this level will hold. You can see on ORCL, okay, today's session, yesterday's session, and the day before, so Monday, Tuesday, Wednesday. Now during Monday's session, we can see we formed a daily high here at 104.69. And then during Tuesday morning's pre-market session, ORCL did try to push, but was rejected at that previous day's high or our resistance. And then you can see price ended up pulling back off of that level and then selling off further. So we've got 2 tests of that resistance level. Now, if you're doing your trading on a 15-minute time frame, well, great. We've just identified some very strong resistance on the 15-minute. Now, if you were to go and short this chart, well, let's just say that 104.69 area could be the place at which you put your stop loss. Okay, that is when you're going to be wrong if 104.69 resistance was to be broken. But knowing that there's 2 tests of this level, I feel pretty good knowing that that level will indeed hold, and then we would end up hitting our take profit wherever that would be. And in this case, it would be identifying our next support level that we can play that move down to. Now, at this point, I feel like you should have a pretty good understanding on not only what support and resistance is, but how to go about identifying those levels on a chart on whatever time frame that you may be trading. So now I want to give you a brief overview of how I implement support and resistance into my strategy as a whole. So ticker symbol DG. Here is my explanation behind putting on the trade itself. And here are the option contracts that I went about purchasing. Now let's pull up this screenshot of the chart at the time of entry so I can explain to you why I took this trade. So essentially what I did was I identified first the trend, okay? You can see this chart is moving from top left to bottom right. We have a bearish trend in play. So overall direction is headed to the downside where we can see these very clear lower lows and lower highs being formed. You can see these lines here. These are what are called moving averages. Now, I'm not gonna reference those today. I'm just gonna be talking about the actual support and resistance that was identified on the chart here at, you can see this area of 107.89 and then 101.69. So 101.69 is going to be our support level. I'm going to look to play a continuation of this trend and of this pattern down into that all-time low. Like I mentioned, a lot of my trading happens around an all-time high or an all-time low on a chart. So what I did was enter this position with the intention of playing a move or shorting down to this support level. So that's what I want to happen, right? I want DG to pull back to this support at 101.69. But we always have to be prepared to be wrong. So where am I going to be wrong? Well, when looking at this chart and identifying the resistance level above head, you can see 107.89 was acting as our next clear resistance overhead. We had a couple tests a week prior of this resistance level, and you could see we had continuously been rejected. And if we did break above that 107.89 area, we broke above resistance, that is where I would be wrong. But you can see we did have a couple tests of that level, so I was even more sure that it would hold. So we had about a 3% margin for profit presented on the chart itself. And then when it came to this position that I was entering, there was a 15% potential for profit behind the option contracts, which I purchased. So I entered on the 10th. Now, 2 days later, we ended up getting that expected move that I was looking for on DG. So if I pull up the chart, you can see here, DG was down 1.75%. Upon exit, we pulled back to that all-time low at 101.69. And if I blow that up for you, you can see we ended up hitting our support level or my take profit. And if we go over to the 1 minute time frame, again, this was a screenshot at time of entry, we got a perfect tap of our support, our take profit. And at that point, I went ahead, I closed this position, locked in 15.43% return. And then on my broker, you can see my order fill, okay? These 12 contracts got executed, bought them at $13.80 per contract, $1,380 if you do not know options, and then sold those 12 contracts for $1,593. In this lesson, I'm going to be talking about the importance of /NQ and /ES. So what is /NQ and what is /ES? Well, /NQ is the E-mini NASDAQ 100, okay? The E-mini NASDAQ 100 index. And on the other hand, /ES is the E-mini S&P 500. As you can see, I've pulled up /NQ right here. And what I'm going to explain to you is how I go about using the levels within /NQ to help me determine where the overall market is headed, and more importantly, where my positions might stand. Now, it's important to understand that you do not want to trade inside a bubble. Now, you want to be aware of the overall market. Where are we sitting within the overall market? What are our levels, our support, our resistance? Be aware of our moving averages. Okay, the 180-day SMA really is the only one I'm going to be focusing on within /NQ and /ES, but it's going to give you a greater understanding for where the overall market is. You don't want to just trade your 1 to 2 stocks. You also want to be aware of where we are within the overall market. Don't trade inside a bubble. I always have /NQ pulled up on the side throughout the day. I check it in the morning. I check it every couple hours throughout the day and towards the end of the day as well. So I'm constantly keeping an eye on these levels, and I'm getting a feel for where we are sitting within the overall market. So some of these lines are previous support. I'm going to take you through where we are right now. And just a reminder, I am on the 4-hour time frame. So today, as you can see, /NQ is up 0.58%. And just a side note, maybe a little tip to help you guys, every morning, part of my morning routine is I always check on Yahoo Finance futures, all right? I want to know were futures green, were they flat, were they red through the overnight session. That's going to give me an understanding of where the market is headed into open. After that, I'm going to look at /NQ, /ES, and see where we're sitting. Okay, are we above support? Are we just testing a support level? Are we looking to break out depending on where we are? Now, I can't say most, but a lot of your positions are going to follow what happens within /NQ. So being aware of these levels is very important. So as you can see, we got this nice push today on open. We're up, a good amount, but we were trading in this sideways range for a couple of weeks, trading below the 180-day SMA. So I want you to ignore the 50-day, this red line, and the 15-day, EMA, this blue line, just focus on this green line, the 180-day SMA. You can see once we lost this level, started selling off, we got this very large sell-off. We did lose these two support levels, but we were able to catch a bounce and start working our way back up. And then we started trading in this sideways range for a few weeks. 180-day SMA acting as resistance. Now, we were fighting pretty hard to break above this level, and you can see once we caught that break, you can see the price started pushing, and we made highs at 14059. So pretty solid recovery after that large sell-off, but that range we had been trading in there was a tough couple of weeks because the market was pretty much trading range bound. Now trying to trade either direction during this time was very hard because of this pretty much sideways chop. Now you can see we made highs at 14059 and we experienced a little pullback yesterday, but today on open we got a nice push, again up about 0.60% on the day. So there's no reason to overanalyze. We just want to be aware of these levels and keep an eye on /NQ throughout the day. If we lose support, we're going to keep an eye on this next level, so on and so forth. Keeping an eye on the overall picture, seeing where we're trading, so we can become more aware of how our current positions are going to potentially react. So keep an eye on /NQ, and the next thing we're going to want to check out is /ES. You can see it looks similar to /NQ, and the S&P recently made all-time highs, which was crazy. So this thing has been on a tear with a smaller pullback, but not quite like what we got on /NQ, as you can see. So similar, but different, obviously, pattern. But just keep an eye on /ES as well, and the levels within /ES. So pretty basic. Just spend some time looking at these, check on them throughout the day, and just be aware of our overall, support, resistance, and that 180-day SMA. Look at Yahoo Finance futures and see where futures were at through the overnight session. It's going to give you a good understanding of where we're headed into open. Now, here's another tip. What I'll often do during the first 30 minutes of market open and during the last 30 minutes of market close is even look at the 1 minute. Now, this is going to give us a better understanding of where the market is on a shorter time frame during that last 30 minutes of close and 30 minutes of open. Now, if during the last hour of the day we see a very large red candle on /NQ, selling off into close, I will be hesitant on entering any positions because the following day there's a very good chance that we will continue that sell-off. But again, it all has to do with current market conditions and where we're sitting. If we were down around here, I would be very aware that, okay, we could even continue selling off. But it's good to just be aware of these things. And like I said, the first 30 minutes to hour of the day, you're going to keep an eye on, both /NQ and /ES, and that's going to help you manage your positions even better. All right, that is going to wrap it up for this lesson. My apologies if I'm kind of tired. I've been recording these videos for a couple days now, and it is 9 o'clock in the morning. I've been up for 4 hours, but the caffeine somehow has not kicked in yet. But anyway, with that said, you can go ahead and move on to the next lesson. What is up, guys, and welcome to the next section. All right, I'm going to be going over the setups that I trade, my setups. Now, these setups work in both bear and bull markets. I've gone ahead and I've added 3 additional setups to hopefully help you capitalize in rough and volatile markets. All right, these setups I've been trading throughout this year, and I've found the highest expectancies with. Now, I want to go over some basic rules when it comes to finding setups. Now, at the end of the day, I am a pattern trader. Now, I'm trying to identify patterns within charts. Now, I do all my work on the 4-hour time frame. Patterns always trump moving averages. Now, moving averages are used to find setups. So to understand what a setup is understanding that a moving average, or the 3 moving averages that I use, the 50-day SMA, the 15-day EMA, and the 180-day SMA, must all react on a chart a certain way. Now, when I say react, if you're looking at a chart and you can see that candlesticks are not respecting certain moving averages, okay, whether it's the 180 day, the 50 day, or the 15 day. And I like to use this word respect, and what it means is that these levels are not acting as either a support or a resistance level. You can see on a chart, if the candlesticks are clearly going through these moving averages, and the chart is a very volatile, choppy chart, okay, and candlesticks are going up and down through these averages without bouncing off of them, then it means that the chart is not respecting those moving averages. And at the end of the day, if the moving averages aren't respected on a chart, then the setup in the first place isn't going to be valid, okay? So the biggest thing when it comes to finding a good chart to trade is we want to find clean and clear charts, all right, where direction is very clear, where moving averages are respected, and then that is going to help us find a setup that is going to have the highest expectancy, or a chart that is going to present the best opportunity when it comes to finding a setup using those moving averages. So if a chart is choppy and it's showing no attention to moving averages, then we have to assume that the setup, which is based off of the moving averages, is not going to be valid. Okay, just restating what I said before. In other words, the 180-day SMA isn't going to matter on a chart where the 180-day SMA is neither acting as a support or resistance. And I'll make sure to give you some examples here shortly. It's important to note that there are exceptions to every rule, but generally we want to stick to what I just talked about, finding clean, clear charts where moving averages are respected, and then finding a pattern, knowing that the pattern is going to trump the moving averages. But when you can find a good pattern with a chart that has respected the moving averages and then find a setup based on those moving averages, that is going to give you the highest expectancy when it comes to taking a trade. Now, you can also take a trade based off a chart pattern, not a setup. Because when I say setup, a setup is based off a moving average, but sometimes the chart is going to present a very clear pattern where you don't need to find a quote-unquote setup using moving averages, where the pattern is going to give you enough information to be able to play the chart. Now, in that scenario, you can use moving averages to manage the trade according to how much they are respected within the chart. And don't worry, I will give you an example of what I just talked about, but kind of spewing information out there. Make sure you're taking notes, because this is a lot to kind of take in and understand. So there's two ways you can take a trade, or two ways I take a trade. You can take a trade based on the chart pattern using moving averages to manage the trade. That's number one. Or you can take a trade based off the moving averages. Now, to take a trade based off the moving averages, which is a setup, means that the moving averages must be respected on the chart. You have to clearly be able to see that they're acting as either a support or resistance, and that candles aren't trading within or through or on these moving averages as if they weren't there. Now, it's important to note that you can indeed take a trade on a chart where moving averages aren't respected, but the pattern must be strong enough to validate taking the trade in the first place. Now, you can use what I like to call candlestick support and resistance levels to manage the trade. Now, that's if the moving averages have no effect on the chart, but the pattern looks great, but you can't use any of the three moving averages to manage your trade because, well, they have no effect on the chart. So instead, what you can do is look for support and resistance levels within the chart, okay, within candlesticks, where a candle has been rejected off a certain level, that's resistance. Basic support and resistance levels, right? So nothing too complicated. Now, kind of going on to a side topic here, this is a lesson that I've learned over the last 6 months so far this year trading that I really wanted to make sure I got in this masterclass somewhere, because this is super important. And I remember I briefly mentioned it when I created this class. Obviously, I'm filming this video after creation because there's always stuff we're learning as traders. It's our job to continue developing a greater understanding of the overall market. And, the market changes. We can't be stagnant. We can't do the same thing year after year without continuing to learn more, develop our strategies, okay? So, adding a couple things. Now, this is important. I'm going to pull up a chart. But sometimes by waiting for confirmation, you will miss out on a good trade, okay? Now, I'm just going to go over Apple real quickly for an example before we move on to the setups that I like to trade, all right? This is important. I need to get this little bit in here for you guys to understand. So I'm going to use Apple. I played Apple earlier this year inside the mentorship group. Now, this is an example of why in some cases you don't want to wait for confirmation, because by the time you get confirmation, you've already missed out on the entire move itself. Now, everyone's waiting for confirmation. Everyone's looking at the same chart, the same moving averages. I talked about this earlier, so it's important that you are within the percentage of people, the small percentage, who are ahead of the curve. Now, by waiting for confirmation, you're waiting for, everything to align, your indicators to align, whatever. And you don't want to do that, essentially, and I'll show you why. So Apple, sorry that the resolution's bad. This was a screenshot. I can try to crop in a bit here. But you can see Apple, okay? We started running up toward that high at 183.38. Now, what I could have done, and what most people probably were waiting to do, was wait for a test of this resistance level, okay? Because we broke out of 177.14, right? Broke through resistance, and now there's no resistance up until 183.38. Now, most people are going to be waiting for a rejection off of 183.38 because price is either going to break through this level and continue running to a new all-time high, or it's going to get rejected and then pull back down. So instead of waiting for confirmation, right, confirmation of a rejection off this level to buy puts and play the move back down, I entered before the test of this level even occurred. Okay, at the time of this screenshot is when I entered. Now, I knew that my max pain on this trade, my max loss, was sitting at that resistance level. So if we did break through 183.38, I would be cutting the trade for a loss. Now, that was 2.60% above where we were currently trading. So doing my calculations, looking at my risk to reward, this trade was worth taking. Okay, you always want to make sure that the trade's worth taking based off your strike rate, based off your risk to reward. So I entered this trade, got in, didn't wait for any confirmation, right? And then walked away with 38% profit. So just an example that in some cases, some scenarios, using your best judgment, right? At the end of the day, we can only make decisions based off of what we know, and no one knows everything. There's literally no one that can predict what's gonna happen. But knowing that most people out there are going to be waiting for confirmation, whether it is an indicator, moving average, a bounce off resistance, a breakout, or whatever it is. We know that most people are waiting for a rejection off resistance, or they're looking to see a breakthrough resistance and then maybe play the breakout. All right, I'm gonna give you an example, like I said I would, of a trade I took based off of the chart and not the moving average. You can see moving averages within this chart are not being respected, maybe a bit here, but generally overall, you can't take a trade based off that. There's no setup I could see based off the moving average. So the only thing I can see within this chart is a very clear pattern of pushes with pullbacks, pushes with pullbacks. Okay, higher highs, right? Direction, overall direction had shifted since we broke above this level right here after making that low at 31.10. Okay, and then we continued to make higher highs all the way up to this resistance we formed at 52.72 back here on that push, right? So we're getting rejected off of resistance, and I was just looking to play the move back down. Judging by the overall pattern, again, I was just looking to play that next move to the downside. We could use the 180-day SMA potentially as a level of support to pull back down to, since you can see the last couple pushes have resulted in a pullback to that level. The 50-day SMA not really acting as anything, okay, not being respected within the chart. So we can look to capitalize on a smaller pullback just based on the overall pattern. We could use the moving average to, manage the trade. But at the end of the day, we're not taking this trade based off a moving average. And I walked away from that trade with a 5.56% margin for profit. So nothing crazy, but a trade that I took solely based off the pattern where moving averages weren't going to help me much. All right. That is going to conclude this lesson. Let's move on to the next one, where I'm going to be talking about how to identify setups and going over the setups that I trade, in addition to the 3 new setups that I just added. Okay, so this next setup, I don't have a great name for it, okay? But what we're essentially doing is we're trying to find a chart with a clear low, a chart that's pulled back and is about at that low. Okay, we're looking to play the bounce off this low back up to another level of resistance. So we could call it like the bounce off low or the support, low slash support. And then again, this is all done on the 4-hour time frame. And I say low before support because this doesn't work off just a basic support level. This works on a low on the 4-hour time frame, okay? Because there's two things that are gonna happen. We're either gonna break down below this low and form a new low, or we're gonna catch a bounce. So it gives you the opportunity, in this case, to wait for confirmation. Waiting for confirmation in this case is good because yes, you might miss out on a little percentage on the entry, but I always say never sweat the entries. I've never made any money sweating the entry. So on SMH, you can see I opened up a position. This was back in April, okay? And you can see SMH had been making lower highs since forming that all-time high at 319.36. Okay, so very clear lower highs. We want to look for lower highs, of course. That's part of our bearish strategy, okay? Bear markets where most charts are going to be going from the top left to bottom right, where the overall trend is bearish. And we're looking for a pattern of lower highs. Okay, there's the same stuff that I'm kind of repeating, but it's important to hear it a couple times. Now, I don't want to seem like I'm contradicting myself. Okay, we always have to be aware of how strong of a support or resistance the 180-day SMA, 50-day SMA, or 15-day EMA will be. Now, depending on the chart, depending on how respected it is, it's either going to act as a stronger support or resistance or a weak support or resistance. Now on this chart, it looks like it's going to be acting as a weak support, or in this case, the 50 SMA is going to be acting as a weak resistance. However, it is still a moving average, which will be acting as resistance. All right, so you can see I was looking at the overall pattern, and I was looking to play a move back up to the 50 SMA, knowing that it would be acting as a level that I can use to manage this trade. However, not a strong level of resistance based on the chart. Okay, and if we do see a break above this level, the 50-day, I'll be keeping an eye on that next resistance overhead, which is the 180-day SMA, very close overhead. And again, it is not going to be a very strong level of resistance. However, it is a way in which you can go about managing your trade, okay? So it's a very straightforward concept where you're trying to find a chart that isn't necessarily oversold, but a chart where a low has been formed, where you're either going to break that low or catch a bounce off of it. If you catch a bounce off of it, play the move back up to a resistance level. Now, there's no great resistance level on this chart because moving averages haven't been respected well, and there's no clear resistance levels within the chart itself based off candlesticks. But like I said, you cannot check every box when it comes to the criteria for your setups. I'm going to make sure to show at least 2 more examples though, so we can see that different charts, again, present different opportunity. They all have a different story. They all will check different boxes. And then it's up to you to decide if the risk is worth taking the trade or not. Now, I don't mean risk as in risk to reward. I mean risk as if you can clearly see that these moving averages, which you're going to use to form your trade plan, are not strong levels of resistance in this case, well, then you're taking on more uncertainty due to the fact that it has not been confirmed in the past that it will be acting as that resistance in the future. I'm just going to show you guys another chart for a different example. Let's go to DOCS. So you can see DOCS had just experienced a very large pullback the day this screenshot was taken and the day before. Big red candle right there. Currently, just catching a bounce off that low. All right, our low, our support level formed at 39.92. So what I did was, well, I entered. All right, I bought some calls. As you can see, I bought the DOCS $40 call, and I was looking to play a bounce off this support. Okay, I set my stop a few cents below support. Now I entered. This could be an early entry. Like I said, I don't sweat the entry. I set my stops, and if we broke below that level, then I'd get stopped out, and that's all right. Keeping my loss to a minimum. Ended up catching a bounce perfectly off that level. Again, I wish I had a screenshot to show you, which is something I will start doing from now on, but I closed that trade for 40% profit. I'm glad that I'm not only showing you examples on live charts, but I'm showing you previous trades I have taken to ultimately show you that what I'm teaching you actually works, and that I, myself, have been able to find success trading these setups this year inside the mentorship. Okay, another one I'm going to show you. There's another previous trade on CMCSA. I believe this was, yeah, here it is. February, end of February, CMCSA. Here we go, okay? Very clear chart here. You can see that low formed at 44.80. I said just formed a new low at 44.80 on the 4 hours, sitting in oversold territory. This chart was oversold. No clear resistance beneath. Okay, so keeping my stops tight just below support, okay? So obviously that low is support. If I entered right there, there was a little green candle being formed, if you can see right there on the 4 hour. Wish I had zoomed in a bit more, but set my stop slightly below there. Again, keeping my losses small if I was wrong, if we didn't catch a bounce off that low. Okay, and I was looking at the pattern, lower highs, yet each time a lower high is formed, price has seen a nice recovery. So yeah, lower highs, yet each time a lower high is formed, price has seen a nice recovery and a push back up to the 180-day SMA. Boom, boom, boom. Looking at the pattern, very clear there. Sitting down about 10% from that level. Okay, 10% down from the 180-day SMA. I was just looking to play the bounce back up to the 180-day SMA. Straightforward play, close out for 31% profit. So that is the bounce off the low or the support level. So looking at charts that are bearish, where there was a recent low formed and where price is currently pulling back. Okay, so recent low. So again, you're looking for a chart where overall direction is bearish, it's oversold. You're looking for a low formed recently, and candles could either be trading right at that low currently, or you could see like a week or two previous, the low had been formed and candlesticks are now trading back down toward that low or about to bounce off of it. So again, every chart's different. Every chart tells its own story. And again, it's important to keep your stops tight with this setup. Keep your stops right below that low. Don't worry about the entry. If you're early, that's fine. But if you are wrong and price does break below that low after you enter and create a new low, then you'll get stopped out and you're not going to lose a lot of money. Okay, so you can wait for confirmation if you want. You can wait for that bounce, or you can enter and set your stops low. Either way, set your stops right below that low, wherever it was formed, okay? All right, that's going to conclude this setup of, playing a bearish chart, playing that bounce off the low. Again, there's a setup you're going to find when the overall market is pulling back. However, we're buying calls, of course, okay? So again, with all these setups providing plenty of opportunity, whether the market's going up or down, for you to play either direction and make money either way. All right, let's go on to the next lesson. I did want to quickly interrupt this video to mention that I do have seats still open inside my mentorship. If you guys are interested, I will put a link in the description below. Now, what you'll have access to is the ability to follow along and copy my trades. I'll send you my entries, I'll send you my exits. Well, at the same time, every day, I'm going to be on a live video call. I'm going to be sharing my screen and I'm going to be walking you through the trades that I take from entry to exit. So you'll not only be able to follow along and copy myself if you so desire, but you'll also be able to learn what I'm doing in this current market to continue finding success. Again, the link will be in the description below. All right, we're going to be going over the next setup. All right, there's a new setup that I'm adding because I've been trading it a lot this year, and I like to call it an overbought / overextended pullback. Okay, now CHR is not the right chart to use for this, so let me pull up XME. Now, this is a previous trade that I took inside the mentorship group. I was charting this thing way back. I believe this was back in January. I'm actually going to pull up the mentorship, and we'll go back to that trade because it's a good example of an overbought, overextended pullback where we're looking to capitalize on a very, as I said, overbought chart. Now, it's often hard to call the top, so you got to be aware that charts can keep running and continue running, so you really want to keep your stops tight if you're going to try to trade this setup. Now, the same principles apply as mentioned in the previous setups and in the first video where I go over just some basic rules when it comes to trading patterns within trends and finding setups based on moving averages. So this is XME, all right? XME was looking super overbought on all time frames. Now, generally, if you throw some stupid indicator on a chart like RSI, you can see it's overbought. Now, a lot of beginners start out with the RSI, but as you learn more and trade more and become more experienced, you don't need the RSI because you can look at a chart like this and see visually that it's overbought. And it's important to note that a chart that is overbought can continue becoming overbought. And so the RSI at the end of the day is pretty ineffective in the sense that if the chart is sitting in overbought territory, well, it could continue pushing. The RSI is not going to keep it from pushing if the RSI is overbought. But I'm looking for a chart like XME that potentially has just made a new all-time high. Now, if the chart has made a new all-time high, the chances are that a retracement is due. Why is that? Well, that is because everyone is going to sell their position to lock in profit. Whoever was part of the rally, part of this 15 or whatever it was % move, over a week or a week and a half is going to lock in profit. Okay, therefore dumping the price. So it's general basic market knowledge paired with just finding the right chart that presents the right opportunity. And now this strategy is going to be a put strategy, but it's not a bearish strategy because the market is not in a downtrend. When we're finding charts that are overbought, it means they're going from the bottom left to top right. So you'll be able to find more charts that look like this in a bull market. However, we are buying puts because we're betting on the price to go down because it's an overextended chart. Now, another downside to this setup is that, well, you can see there's no moving average or, resistance level overhead that we can use to go about managing the trade, figuring out where we're going to put our stop, where we're going to put our take profit. You can even see on this chart, none of the moving averages are respected. So when it comes to trading overbought or extended charts and capitalizing on a pullback, it is probably one of the riskiest setups, but with one of the highest rewards, okay? More risk equals more reward. We all know that, but know that the expectancy for this setup is not as high. Now, with that said, it is still, a setup that presents itself less often than the others, but there is good money to be made if you do find a chart like XME that is sitting in extremely overbought levels. Let's see, we made 14%. And here's another example. All right, FSLR. Now, I got in too early on this one. I tried to play this, kept getting squeezed up. I don't know if squeeze is the right term because it wasn't a short squeeze, but price continued to rally, right? We broke through that high, the all-time high on the 4-hour, and we continued to push until that new high was formed at 121.91. On charts like this, I'm going to give you two examples. I'm going to show you Apple. I'm going to show you FSLR because this is essentially one and the same. It's an overextended, overbought chart where we're looking to capitalize on the pullback, but this FSLR and FSLY specifically, we can use our moving averages to help us actually make a trade without going in so blindly, without as many, not indicators as in chart indicators, but indicators as in using our rules and our checklist and not being able to check all those boxes. So you can see right now, okay, 15-day EMA has been acting as a support level on our way up, okay? Previous to this rally, it was just very chop within the candlesticks and was not respected. Now, on a nice rally, this is where the 15-day EMA comes in handy because you can use it as an indicator or indication of a reversal. You can see we started breaking below the 15-day EMA and started to top out here. Ended up breaking below completely. And at this point, you can see the 50-day SMA has almost caught up and has almost crossed the 15-day EMA. So now we can look at the 50-day SMA as a support level. You can see it has not been respected previously, but on our way up, it was able to make some distance between the 15-day and itself. Because you can see right here, look how close these two moving averages were trading to each other. At this point on the chart, we're still sitting very overbought. We're looking at roughly a 20 to 22% margin for profit, back down to the 180-day SMA, okay, which we can see has not been respected either. So that's a tough thing. When you look at overbought charts, and you could see a very choppy chart previous to the rally where moving averages were not respected, then you know right away that we cannot use this level to gauge whether it is going to act as a level of support or not. Now, the way I'd look to play this chart is, give it a couple more days, see if we start trading clearly below that 15-day EMA. And then not saying that the 50-day SMA is going to act as a support level, but if we're trading below the 50-day SMA, that means that direction is overall more than likely turning around. Okay, direction has shifted. We've lost our volume, we've lost our momentum, and it's time to get in with a put. Okay, so this is, again, not a strategy you're going to play with a bear market. It's a strategy that more than likely you're going to play during a bull market, but you are buying puts because we're betting on the price to go down. Direction shifts. It's overbought. Now let's check out Apple. And again, it's hard to find a chart that checks all of our boxes. Okay, it's very hard. So you have to be picky, but you can't be too picky. Now with Apple, you can see we formed that low at 129.04. Since then, have been rallying. Now, Apple, I was waiting for a break below the 50-day SMA. You can see the 50-day SMA 1, 2, 3, and I would say 3 times has been validated as a strong support level. The 15-day EMA isn't giving us much here, so I was waiting for a break below the 50-day SMA now, and this is a trade I may enter today. But I can see based on our support levels within the chart, I could play the move back down to 162.78, maybe even 159, maybe back down to the 180-day if it has been respected on the chart, which it has not. So I'm going to be just looking at playing down to the next support levels within the chart, knowing that the 15-day EMA and 50-day SMA will be trailing above. And then if direction shifts, I can cut based on where those moving averages are according to my strike rate and risk to reward. But this is a good, pretty overbought, overextended chart that is now turning around. Confirmation in this case would have been a break below the 50-day SMA, at which point I would wait for a candle or two to form below and trade below the 50-day SMA, at which point that would let me know that direction has shifted and I could get in and grab a put and make some money. As you can see, not all charts or very few will present all the criteria that you need to find the perfect setup. There's no such thing as the perfect setup, or you're going to have a hard time finding it. So don't get caught up over finding the perfect setup. Find a chart that checks as many boxes on your list as possible and make the most educated decision that you can, okay? At the end of the day, we're traders. We're not right 100% of the time. You're going to find charts that look great and they end up doing exactly the opposite of what you predicted. That's just how it is. Again, manage your risk. Keep your stops tight and make sure that, you're keeping your losses small. Just to kind of go over what we talked about, we're looking for a spike in volatility within the chart. Okay, overbought, overextended. And it's important to note that it's hard to call the top and the chart can continue to run. That's why it's often good to wait for some sort of confirmation of a reversal before entering, like I showed you here on Apple. Okay, that's why I got in trouble the other day on FSLR. And now looking at FSLR, you can see we are breaking below the 50-day, but as I mentioned, it has not been respected on the chart. So what we really want to see is 2 or 3 candles form below the 15-day EMA for confirmation of a reversal. We can get a fake out, all right? Now, depending on the chart, again, overbought, overextended, it may be making a new all-time high. It may have some space to go to another resistance level. So we can use that information as well on Apple. If we were impatient and we entered before confirmation of a reversal, before a break below the 50-day SMA, we could set our stops somewhere around 179.70, knowing that that is our next level of resistance overhead. Calculate the margin for profit. How much are you going to be down at that point if you're wrong? We couldn't have done that on FSLR back when I was trading it last week because obviously you can see there's no previous high we can use. So again, all charts are different. All charts tell their own stories. Do your best job and make your most educated decision based on what you know. All right, that's going to conclude this setup video. Let's go ahead and move on to the next one. All right, so this setup I'm going to be going over, I like to just call a pullback play or pullback setup. There's no fancy word for it, but we'll go over the criteria. So essentially, we're going to be looking for a chart where the pattern overall is bearish, okay? Descending pattern. You can see on CHTR, we've pulled up the live chart right now. I will use some examples of trades that I've taken so far this year inside the mentorship group, but looking at CHTR, you can see we have clear, resistance at the 180-day SMA. Now, when we're looking at charts to find a chart that is suitable for this pullback play, right? We want to see preferably clear rejections or at least candlesticks trading below the 180-day SMA. You can see recently we did break above the 180-day SMA, was not able to hold above and did pull back, okay? So that is still confirmation that the 180-day SMA is acting as a resistance level. Now, when it comes to all of these setups, I am looking for at least a 3 to 5% margin for profit. Now, the idea here is we're identifying a chart. Overall direction is bearish, very clear pattern of lower highs trading below the 180-day SMA, and has formed a low recently on the 4-hour time frame. All my work's done on the 4-hour time frame. You can see we've got a low here at 407.75. Now, what we're looking to do based off the overall pattern, right? The pattern you can see here of very clear lower highs is play the move back down to that low, okay, that low at 407.75. Like I said, rejections at the 180-day SMA aren't necessary to play this pullback play, but they will support an even stronger justification or an even higher expectancy when you do enter. The chances that this trade is going to play out in your favor are more likely if we do see that on the chart. Now, all we're looking to do is play the move back down to that low on the 4-hour, okay? So we can calculate our margin for profit, and we are looking at a 8 to 9% margin for profit down to that low. Let's look at another chart, RIO. Okay, you can see RIO. We got that high 85.50, okay? Lower highs all the way down to that low formed at 53.33. Okay, 180-day SMA is not being respected. We could see that price candles. We can see that candlesticks have moved through this level without hesitation. All right, so we do not have that stronger level of confirmation that this is a valid setup, but we can see that recently we are forming lower highs, okay? Direction did shift as the overall market shifted within the last couple of weeks, but overall, the pattern presented is still this very clear pattern of lower highs where we can assume that, to our best knowledge, Rio will be making a move back down to that low at 53.33. Again, we're not seeing everything I like to see on a chart, so maybe this is a chart that you'd sit back and watch or decide not to play. We're looking at roughly a 10 to 11% margin for profit. It is a choppier chart than I would like to play, and at the end of the day, these moving averages that I trade are not being respected. So I myself would probably sit out on RIO. Now, it's important to note that we could still take this trade, but due to the fact that the moving averages are not respected, we would more than likely want to manage this trade based off of candlestick support and resistance levels. Okay, so if we could see, we ended up getting rejected right here at 62.36. We've got resistance. Okay, another rejection, that is how obviously just basic support and resistance works. And we're not going to be looking at the 50-day, the 15-day, or the 180-day estimate because you can see that, these candles clearly don't care about these moving averages whatsoever. So we're not going to use them when it comes time to figure out where we're going to cut this trade for a loss, and obviously taking profit down at that low. Now, I'm going to pull up a couple trades I've taken so far inside the mentorship group that perfectly represent this pullback play. Now, if it's not clear already, this is obviously a setup to trade when the market is bearish because we are buying puts, right? We're playing the downside on this pattern that we're locating. And these charts that present patterns and the setup that we're looking for will be more common when it is a bear market. Here's a great example of a pullback play. So ticker symbol WHR. Took this back in February, okay? I did quite a bit of charting here, a little analysis. You could see high formed at 245.44. Right away, we could see these moving averages are not being respected whatsoever. So overall direction since that high formed at 245 is bearish. Okay, we've seen a clear pattern of lower highs, and just charting out a basic, trend line, we can see we've been making this very consistent pattern of lower highs. Now, we pull back to 193.47 where we formed a low. We broke through that support level, all right? Very clear lower highs, as I noted. What I am looking to do on this chart is play the rejection. You can see where we're trading right here, the rejection off of that trend line. And that trend line was located by pretty much just lining up the tops where we were rejected. Even if we do break through, I'm not a fan of trend lines. It's a good way to give you a visual representation of a pattern, but there's no formula behind it. We know though that there is going to be resistance at 207.54. So when I go to enter this trade, I'm not going to be cutting it obviously if we break above this little trend line. I just use this more of an example so people can understand there's a clear pattern there being formed. But I would be doing my calculations when it comes to risk to reward and where I'm going to cut for a loss at the level of 207.54. So I entered right here and I was looking to play the move back down to 193.47. Okay, pull back to that low on the 4 hour, which is the pullback play. And there was a 5 to 6% margin for profit presented. And you can see, a break above roughly 207.54 is where I was looking to cut this if we did get a rally and break that pattern of lower highs. And just a couple days later, I closed that trade for just about 53% profit. Okay, I wish I had a screenshot. Now I should do that from now on. When I close the trade, I will put a screenshot of where the chart is at because I'd love to have shown you right now, but obviously don't have the screenshot there. And it's just going to be very confusing and the chart's going to be skewed if I pull up a live chart and try to scroll back. But we did play that move back down to that low, and that was a great trade. Obviously 50% plus profit is an amazing trade. All right, on to the next example of a pullback play. You can see ticker symbol UBER, Uber. Right, we all know Uber. I identified that very clear pattern of lower highs, overall descending pattern. Right, chart is bearish. It's going from the top left to the bottom right. If it was bullish, it would be going from the bottom left to the top right. All right, as you can see, we recently pulled back, finding support and making a new low at 2016. All right, so you can see that low is formed, and I am just looking to play the move from where we're currently trading back down to that low. Okay, very clear pattern. Can't use the moving averages there. Well, we could, but just know that the less effect they're going to have is either a support or resistance level. So we could still, use the 180-day SMA as a level of resistance. Okay, you can see right there, we did get rejected at the 180-day SMA. So it might be acting as a bit of resistance, but overall we can see it really hasn't, right? At the end of the day, there's no exact formula you can follow. You just have to use your best judgment based off of what you know. Now, the more charts you look at, the longer you trade, you'll just get better at doing this. So in this case, I was looking to play the rejection off the 180-day SMA, okay, because I did see that we did get rejected right there. Now, I don't want to seem like I'm contradicting myself. I did end up managing this trade based off of the 180-day SMA. You look at the bigger picture, obviously, the moving averages aren't being respected, but on the shorter term or the, looking a little more in depth, okay, the smaller picture, however you want to put it, you can see we did get rejected right there at the 180-day SMA. So the immediate pattern, okay, the immediate previous move I'm using to base this current play off of. Again, it's just chart knowledge. It's spending hours and hours and hours looking at charts and seeing how candles react to these averages, always being aware of the overall market at the current time. Maybe the overall market was at a level where I was confident in a rejection. There's a lot that goes into this. So we always, again, want to look at the bigger picture, but I was just looking to play the move back down to 2016. All right, there was a 10 to 12% margin for profit presented. Stops were around 2% to the upside, which was right around where the 180-day SMA was at time of entry. Ended up closing that play for 46% profit. Okay, so that is going to be my last example of a pullback play. Now, I'd say these are pretty easy setups to find right now due to the overall market. Again, it is hard to find a chart where the pattern is clear, the chart is clean, moving averages are respected, there's clear and very accurate levels to play off of when it comes to support and resistance. So the more things you can check off your box when it comes to the rules to finding a setup, the better and the higher expectancy or the higher chance of that trade playing out in your favor is. So keep that in mind. You can play a chart that looks like Rio, but know that the chances of that trade actually playing out as you predicted are less due to the fact that you can only check off a couple boxes on that checklist. All right, let's move on to the next setup. So in this video, I want to cover the 3 setups and their correlating checklists so you guys essentially know what to look for before placing a trade, okay? Now, I have linked all of these setup checklists below. If you want to download the PDFs, you can take these and use the actual boxes, check them off as you go. But I want to premise this by saying you do not need all of the boxes to be checked to take one of these trades. However, the more boxes we can have checked, the better. So you'll see under each setup checklist, I've got both the entry criteria that we're going to look for and the trade management, because based off the setup, we're going to be looking for different things upon the entry. And when it comes to, how we actually go about managing that trade, we're going to manage that trade specifically based off the setup in different ways. Okay. So to start off, we want to look at the ATH pullback setup. If you guys want to pull up this PDF or just watch this video and do that after, that's fine. So as far as entry criteria, we're looking for the overall trend to be bullish. Okay, we're looking for the chart to be sitting at or slightly below its all-time high. And preferably, we'd like to see that the all-time high was just formed. Okay, we want to see that the 15-day EMA is currently respected, and we want to see that the 50-day SMA is currently respected. Preferably, like I said, all of these boxes will be checked off, and the more boxes we could check off, I would say the more confirmation it is that that trade will actually play out in our favor, right? Now, as far as the trade management, we want to, with this specific ATH pullback setup, we want to either play a break below the 15 and short to the 50, okay? So break below the 15-day EMA, short to the 50. We want to short off the all-time high down to the 15. We want to short off the all-time high down to the 50, or we want to play a break below the 15 and 50 and short to support. So if we're setting up at an all-time high and the 15-day is respected, we'll short down to the 15. But if the 15-day isn't respected and the 50 is respected, we'll short down to the 50. So you have to look at whether the moving averages are respected or not. With trade management, we're not trying to check off all of these because these are opposing. So it will be one of these boxes will be checked, right? So out of these 4 ways to manage the ATH pullback, you're going to choose one of these 4 ways, and that will be based off of, what the chart actually looks like, okay, where that stock is sitting, and what moving averages are being respected or not. Okay, all the charts are going to tell different stories, so just know that one of these 4 trade management is going to be the criteria to manage this trade. Okay, one of these 4. Okay, all right, moving on. The ATL bounce, our entry criteria, overall trend is bearish, all-time low just formed or previously formed, okay? 180-day SMA currently respected, 50-day SMA currently respected, 15-day EMA currently respected. Now, it will be hard to find a chart where all of the 3 moving averages we use are respected. However, like I said, the more moving averages are respected, the better. Okay, so this setup's a little more straightforward because we're just looking to play a move off of that all-time low on a chart. And as far as the trade management goes, right, we could see playing the move off that all-time low. We're either going to go long off the all-time low up to the 15-day. Okay, if the 15-day is respected, we'll play up to that. Long off the all-time low up to the 50-day, or long off that all-time low up to a resistance level. Pretty straightforward. Next, the pullback play, one of my favorite setups personally. Entry criteria. Overall trend is bearish. All-time low just formed or previously. Pattern of lower highs. Okay. Pattern of lower lows. Or I read that backwards, but lower lows, lower highs. We want to see both being played out on that chart. 180-day SMA respected currently. 50-day SMA currently respected. 15-day EMA currently respected. Pretty straightforward setup. You know, overall trend is bearish. We just saw that an all-time low was just formed or previously. We're essentially just going to play that move in short down to that all-time low. And we want to see these moving averages being respected. All right, so those are the 3 setup checklists and what you should be looking for as far as entry criteria and how you're going to go about managing each trade, okay, based off of whatever setup you are actually trading. Hope that helps. Download the PDFs below. All right, in this lesson, I'm going to be talking about watch lists, how I go about setting up my watch list to create a organized and a smooth workflow. Now, this is very important when it comes down to boiling down the stocks that I am going to trade. This is the method in which I not only sort through different groups of stocks, but I begin to narrow down those stocks into the potential trades that I want to be taking or have taken. I've got 4 different watch lists. So you can see up here on the left, we've got potential stocks, we've got close watch, and then we've got ready to trade and open positions. So 4 different watch lists. Now, how do I use these and go about applying these to my trading? Now, in the next lesson or a couple lessons from now, I'm going to be covering how I find stocks. So you're going to need to watch this video before you watch that one and have a thorough understanding on how I have set up these watch lists so you can then start sorting through stocks and putting them in the correct watch lists. The first watch list is going to be potential stocks. Now, this is going to be, depending on whether trading is good or bad, this is going to be 50 to 100 different stocks. Now, if I start scrolling through, you can see I haven't done any technical analysis on any of these stocks. These are stocks that I've pulled out when I was scanning and I've added them to this watch list and that I plan on narrowing down further. I'm going to go through them, I'm going to look at them again, and if I do see potential, I'm going to further narrow them down into my next watch list, which is going to be what I like to call close watch. Now, these are the stocks that I'm going to be watching on a closer basis on, a weekly basis. Typically, I'll have 10 to 15 stocks, again, whether trading is good or not, inside this list. So this list is going to be a list of stocks that I have further boiled down that I have not only identified a pattern / a setup on, but I have also done further technical analysis and I am preparing to potentially make a trade. Now moving on to my next watch list, ready to trade. This is pretty self-explanatory. These are the stocks that I'm going to be watching very closely within the day. I've already made a trading plan, or at least started to formulate a trading plan. I've got a very good idea for the setup that I'm going to take, and I'm pretty much just waiting to make a move to trade these stocks. So today I only had 4 on that watch list, never really more than 5, and sometimes only, like I said, 1 or even 0. As you can see, I've already started formulating a trading plan for these stocks. Some I haven't, but I've either started to make my trading plan or I will do that later on in the day. But these are the stocks that I'm very closely watching and that I am essentially ready to trade. And then the last watch list, the 4th one, is pretty self-explanatory. Open positions. If I have any open positions, I like being able to see them and pull them up right away and not have to scan through any watch list. So I will add any open positions I have to this watch list, and then once I close, I will take them off. So 4 different watch lists, pretty straightforward. This doesn't only help me stay organized, but it helps me keep an eye on those stocks that I am about to trade, ready to trade, depending on which watch list it is in. That's going to wrap up this watch list lesson. And either in the next lesson or the one after, you're going to see how I actually go about finding these stocks and sorting them into each watch list. But go ahead, set up these watch lists. You don't need ThinkorSwim. If you're using another platform or brokerage, just go ahead and create 4 different watch lists and name them whatever you want. But that's the general idea. The first watch list, potential stocks, we've got 50 to 100. The second, close watch, we've got 10 to 15. Ready to trade, we've got 3 to 5, and then my open positions, whatever amount I have open. All right, I will see you guys in the next lesson. So trading psychology is one of the most important topics when it comes to trading, if not the most important. I like to think of trading encompassing 3 main topics. One of those being trading psychology, the second being risk management, and then the third being, well, the actual trading itself, right? Finding these setups, doing our technical analysis. Now, a little disclaimer, I am not a psychologist. I'm just going to be sharing with you what I have learned and what has worked for me. Now, to start off, I'm going to break down 2 separate topics within trading psychology. The first one being your mental well-being. Okay, so your mental well-being. Now, I like to use sports as an example. So let's pretend that you are one of the football players on a star football team in college. You want to play at your best game, okay? So what are the types of things that you are going to implement on a daily basis to play at your top game, at your best level? I'm going to be jumping back and forth between this analogy of being a football player and being a trader. So I want you to ask yourself a question. Is there anything in my life that could be hindering my ability to make the right decisions? Is there anything distracting you? Is there anything on your mind? Now, trading is going to take your full attention and your full focus. Now, just like training to become this elite football player, you're going to be spending the majority of your time doing that. So trading is the same. Essentially, trading has to be your full attention. You don't want to be focusing on other things. Your main focus has to be on trading. Your main focus is trading, okay? So you have to think what in your life could be distracting you and drawing you further away from trading being your main focus. You have to make trading your priority, just as if you were a football player, you have to make training your priority. So our next topic is going to be your physical well-being. Now, your physical well-being, a couple of things you want to think about are, did I eat breakfast? Did I get enough sleep? Have I gotten exercise? Well, these may seem like basic things. They are vital into making sure that you are performing at peak performance. And often you're spending hours on end staring at a screen. So you have to be able to get out, get that exercise, not only clear your mind, not only for your mental well-being, but for your physical well-being. All of these things go hand in hand into, again, making sure that you are performing at your peak performance at your best level possible. Now, I work out every day. I have a gym on my patio. I will walk outside. I will get a 30-minute workout in, during the day. I'll work out after. I definitely attribute a lot of my success towards my physical and mental well-being and maintaining both of those. But think about this, just like a football player or an athlete wants to make sure that they are eating the right food, they have a balanced diet, they are maintaining a healthy lifestyle outside of their regular training, these everyday things as simple as what food you're eating, all attribute to, again, mental well-being and physical well-being. If you just eat junk food all day, how well do you think you're gonna feel? If you're focused on something else, if you're stressed out, if you're thinking about a million different things, well, how do you think you are going to perform? Good habits being, eating right, exercising, getting enough sleep, maybe spending a little less time on that video game that you like playing. Kind of a basic saying, but it's so true, and doing this will contribute to your success and your performance in the market. So healthy mind, healthy body. Are you taking care of your body? Are you being conscious of your physical well-being and your mental well-being? And sure, maybe working out isn't your thing. So I don't know, go out on a ride in your car. Go drive around in your car. I have a sports car. I like going out and I'll go on an hour-long drive, or I'll go on a 10-minute long drive up through the canyon. And maybe that's to get your mind off of trading for a couple minutes, to de-stress, whatever that may be. Find out what works for you. You have to have a balance. You can't just spend the entire day staring at your screens. Go out on a drive for 30 minutes, go work out for 30 minutes. Do these things to help maintain both your mental and your physical well-being. Now, a third topic I'm going to dive into is preparation. Okay, so back to our football analogy. Do you think that football players just show up on game day, run out on the field, and go 100%? Of course not. They're going to take their time to warm up ahead of the game with their teammates. Why is an athlete warming up? Why are we preparing for a trading session? Well, we are trying to get to the place where we can perform at our peak performance. Peak performance is really the underlying goal, right? We are doing all of these things to make sure that we are at our peak performance. So you're probably thinking, okay, what do we do for preparation when it comes to trading? Well, I like waking up with at least an hour and a half to stimulate my brain, to take a shower, to eat breakfast. And what I also like doing is I perform a bit of a mental checklist, because I want to gauge where I'm at emotionally heading into the day. Is there anything on my mind, again, that could be hindering my ability to make correct decisions, or that could be distracting me from the market? You want to gauge where you are mentally and physically, and this is so you can have a better understanding of where you are going to be at once that bell goes off. If you are not already, I highly encourage you to be taking notes, writing this stuff down. Again, you can go back and watch this video. So trading psychology is a very important subject, and one that I'm going to cover further within the next video. This is the mental, physical, and more of the prep side of making sure that you are ready to go ahead and perform in the market. Later on, I'm going to talk about some of the other aspects of trading psychology. So I hope you guys did enjoy this lesson. Let's go ahead and move on to part 2 of trading psychology. All right, this is going to be the second segment within trading psychology. So I'm going to jump right into it. The first topic I'm going to be covering is how to deal with a loss, right? How are you going to deal with losing? Because it is inevitable that you're going to lose money when trading. Now, that is part of it. That is how you learn. That's how you learn what not to do next time. So losing money is part of trading, and you're going to have to accept that. All right, the first thing that you have to be able to do is get away from the money aspect of trading and instead focus on the trade itself. Again, just a reminder, make sure that you're taking notes throughout these lessons. So what do I mean by get away from the money aspect of trading? Well, one thing that a lot of new traders do is they focus so much on their P&L, right? Your profit loss, you're constantly staring at that, you're constantly checking it. The best thing that I recommend everyone does, turn off your P&L, don't look at it, because by doing that, you're shifting your focus away from the money part, which is going to be, you know, how much you're up or how much you're down, to instead, now your focus is going to be shifted on the trade itself, right? The chart. Why did you enter? Why are you actually trading? Because you're not just trading to make money, or maybe you are, but you need to take yourself away from the money aspect of it, focus on the trading aspect of it, and the money will come. Now, it sounds cliche, especially when you see, you know, a lot of the money flex stuff with a lot of trading people out there with their Lamborghinis and sports cars, or just, you know, my Rolex, because money is essentially the foundation of why you're probably doing it. And that's why it's so hard for people to not focus on the money. But you have to be able to draw yourself away from looking at your P&L, from focusing on how much you're up, how much you're down. That is such a huge psychological aspect of trading, such an important part that is going to lead to your success as a trader if you're able to forget about the money. So please do yourself a favor and turn off your, wow, I'm writing sideways, P and L, okay? Turn off your profit loss. That's gonna help you. Please go ahead, go over to your brokerage, turn it off. Now there's gonna be many highs and lows, okay? Highs and lows of trading. And how you go about dealing with a win or a loss is going to be very important. You should be able to walk into a room with your family and they shouldn't be able to know whether you had a green day or a red day. Now, trading is like a roller coaster. You're going to have extreme highs, extreme lows, and maybe you'll just, crash, but eventually you'll get back up there, we're hoping. My point being, you're going to deal with insane amounts of adrenaline, of stress. This is a stressful job, but how you go about acting on your highs and on your lows is important. You have to reward yourself in a consistent way. Now, I didn't make this up, right? I'm not a genius when it comes to this, but I've learned this stuff over time and I've spoke with really great traders, okay? You have to reward yourself in a consistent way. And what I mean by that is, when you have a huge day, say you make $10,000 in one day, you're gonna feel like you are on top of the world. But the next day, you might lose whatever, $5,000, $15,000, depending on how much you trade with, and you are going to feel awful. The previous day, when you made $10,000, how did you go about treating yourself? Did you go out and buy yourself something nice? Did you go on this big high and start bragging to your friends? Did you go out and party? Are you rewarding yourself for that big green day? I heard a really good trader put it like this: you don't want to jump for joy on your green days and go into a depression on your red days. See, you're not only looking for consistency within your trading, you're looking for consistency within your mindset, with your psychology. You can't deal with these giant fluctuations in emotion. It's gonna happen. You're gonna have to work on not riding that mental roller coaster. You might be riding the P&L roller coaster, right? Your profit and your loss is gonna be up and down, but you can't let your brain get in on that ride, okay? Don't reward yourself on your green days and don't go into a depression on your red days. Try to stay consistent. The problem with celebrating your green days, you might just be celebrating an awful trade, okay? You don't want to reward yourself based on how much money you made, because maybe you just got lucky. Maybe it was a really awful trade, but you ended up making money on it for one reason or another. So don't reward yourself on the money aspect. Again, we're trying to take ourselves away from the money aspect. Reward yourself on the quality of the trade. So you can go ahead and write this down in your notebook. Don't reward yourself based on the dollar gain, right? Whoa, that was a bad G. Instead, reward yourself on the quality of the trade. All right, I already gave you a heads up. This isn't going to be pretty. Essentially, you're doing this because the moment you reward yourself for a trade based on the dollar value, you might be rewarding yourself on an awful trade, an awful setup that you should have never taken, yet you got lucky. And what happens is, the more and more you do that, well, you're going to keep falling into this same trap, and eventually you're not going to get lucky. You're going to be celebrating some really awful, as far as quality trades, some really awful trades. Even though you might be making money, you shouldn't be, but you are. But eventually you're not going to be. So if you're going to celebrate, and of course you're going to want to feel, and you are going to feel good. When you have a green day, you're going to feel good. That is just normal human nature. So if you're going to celebrate based on the quality of the trade. That is going to conclude part 2 of trading psychology. I don't want to throw too much in your face at once. Once you've gone through and thoroughly, watch this video, taken notes, you can go ahead and move on to part 3, our final section within the trading psychology segment of the course. All right, you've made it to trading psychology, part 3, the final section within trading psychology. And what I hope you're starting to understand is the importance of trading psychology and the fact that you can know how to read every indicator and every moving average in the world, yet if your trading psychology isn't in check, you are not going to be a successful trader. In this lesson, I'm going to be jumping around between a bunch of smaller topics. So what is revenge trading? Well, essentially, revenge trading is after you've taken a large loss on a trade, you are then trying to make back that money you've lost out of frustration. And this becomes a very vicious cycle because what happens is once you've taken one loss, you try to make back what you lost on this next trade. And then that trade goes south again for one reason or another, mostly because you're so focused on making back that money you lost. Well, now you're down on 2 trades and you're trying to make back what you've lost on those 2 trades. So you can see how it just kind of never ends. Now, what also happens with some traders is they will go with, their typical position size, whatever that may be, and say that trade goes south, they cut losses. What they're gonna do then is double down and try to make back what they lost. And then if they lose that trade, well, now they're completely panicking and they're gonna go with just a teeny position size. And if that even ends up going well, they're not going to be able to counteract the hole they just dug themselves in. So I'll get into this later, but I think it's worthy to mention it right now, is never, vary position sizes depending on your confidence within the trade. Now, this is a mistake that I made early on and that I continue to make. And it really took me some understanding to realize that if I consistently kept the same position size, trade and trade again with my strike rate over a long period of time, I was still going to be successful. So don't vary position size based off of your confidence within the trade. I wouldn't say vary position size at all. Again, we're going for consistency, so stick to one position size. So don't revenge trade. And the next topic is going to be, you have to know when to step away, when to take a step back from your screen and really do a mental assessment. Just like revenge trading, once you start digging yourself maybe in a hole and you realize that this isn't improving, all right, I am just getting more frustrated, I am getting more flustered, trying to dig myself out of this hole. That is, once you've gotten there, you've already gone way past the point where you should have stepped away. So you have to know when to take a break, when to go outside, go on a run, get some exercise, go out, drive in your car, just get off your screen. Because sitting on your screen and hoping that you're going to be able to, reverse whatever it is you're doing on the day wrong, you need to be able to take a break. This might be a 30-minute break, an hour break. This might be a day that you just don't trade in the market. But if you have really, dug yourself into a hole, and if you have consistently, and I'm not talking, your normal down day, your normal red day. Everyone is going to have a red day. No matter how good of a trader you are, everyone deals with red days. But if you have consistently had, a week or 2 or a month of just red, I would recommend that you take a week, maybe a month, okay, if you can do that, away from the market. It gives you time to refresh, reset, and then once you come back, you're ready and you're most likely excited to get back into it. So take a step back, whether it's on the day for a couple minutes, or realize that you need to take some time away from the market. Now, just the other week, I had been doing very well, and then I hit a patch of pretty much consistent red trades. And what I did was I stepped back, I took an entire week off, and I came back ready to trade with a clear mind, a fresh mind, and most importantly, any emotion that I had built up from that red streak, that losing streak, well, I had shaken that, I'd got rid of it, and I was coming back in emotionally ready to perform at my peak performance, okay? So back to the peak performance, you want to be able to mentally check yourself. And if you have consistently been having red days, okay, and I'm not talking about because the market's been red, I mean that whatever it is that you're doing is not working, you need to be able to take a mental check and realize that you're not going to get any better by continuing trading, and you need to take a break. So work on just recognizing this and recognizing when you need to take a step back, all right, and to take a break from trading. Next, I want to talk about something that happens with a lot of new traders and what really is just beginner's luck. Now, maybe you have decided to start trading, you've made, one or two trades, or you're a couple weeks into trading, and all of a sudden you hit the jackpot. You have a huge trade, and all of a sudden you think that you are a trader. You are a day trader now that you have made all of this money, when in reality that was just beginner's luck. Now, it might take a little bit, but eventually you're gonna realize that, well, that was just beginner's luck, and that I actually have no idea what I'm doing. So I need to figure out how to trade. And then what happens is, again, you'll hit a jackpot, or you'll have a big trade. And there goes your ego. Well, I guess I do know how to trade, because now it's happened twice. Now, what I'm trying to get at is, and I mentioned it earlier, and it may sound cliche, but consistency is key. I've had traders come to me and say, look at this, I just made $50,000 and I've only been trading for 2-3 months. And I'll ask them, how much money have you made since you made that $50,000? And they might say, oh, yeah, I've lost $10,000, or I've made a couple $100. And then I'll say, how did you make, that a couple $100? And typically I'll get the response of, I have no idea. I was just trying to do what I did the first time. And right away, I'm like, oh no, this is not good, because what happened was they had one big hit in the beginning, and now they think that whatever they did that made them money is the correct way to trade, when really we come back to what essentially was just beginner's luck. All right, and maybe they'll say, well, I'm down $5,000 after I had that big trade. And I like to hear that answer more, because at least in that position, they know that they haven't figured it out, that they're not this genius trader, that they just had beginner's luck. Now, being able to realize this is vital in moving forward as a trader. You have to put your ego aside and forget about whatever it was that you did first to make that money. And you actually have to now learn how to trade. And I know this scenario might have only applied to a couple people, a couple of you watching this. I'm sure you've had some great beginner's luck, and that psychology has already messed you up. And I'm not sure at what point you are in, this beginner's luck phase, I like to call it, whether you've now lost money that you've initially made, or that you've slowly started to make money back, but really can't figure it out, and you're still clueless as to how you made that money initially, but you've got this ego where you think you know how to trade. Either way, you have to realize it before you can fix this issue. And not to say that it's an issue, but you won't be able to progress if you think you know everything because you got lucky one time or two times. And similarly, this also applies to traders that have maybe had a year or two of experience, who go on these big winning streaks and then proceed to just blow up their account. Now, I would rather see traders consistently being able to make money, even if it's only a couple $100. If you can make 10 trades, and out of every 10 trades, 8 of those trades are green, over 100 trades, you've had 80 green trades, even though those are maybe only a couple $100 profit, that is better than having 1 or 2 huge trades randomly, okay? Because you have to identify what is working for you. And in order to do that, you have to be able to have this level of consistency, because we are here as traders for the long run. We're not here to make, a couple $100,000 in, a year or two, and then proceed to lose that all because we haven't been able to find any consistency within our trading. So if you can consistently make money, even if it's only $10, $15, $20, that is better than losing money, right? Because you're eventually going to be able to scale your account, and you can start working with more capital once you have found a strategy and a system that you are able to execute on a regular basis and find consistency. I want to see traders have consistency over just having, a big winner here or there. Kind of another topic I want to touch on is just blowing up your account, okay? So blowing up your account, it happens to everyone. It happened to me. I'll tell you, when I started learning how to trade options, I started with $10,000. I quickly proceeded to lose about $9,800 of that $10,000, which I then proceeded to put $5,000 more in that portfolio and then lose that too. You will become better at dealing with loss and coping with the losing money, but initially you are going to lose a lot of money. You will blow up an account or two. And it's very important to realize this, because I can, preach this stuff all day, but you're never going to truly understand until it happens to you, until you lose money, until you blow up your account, and then you learn from that experience. Over time, it will become easier to lose money. And I say that because you will become very numb to losing money. You will realize that it is part of trading. Everyone loses money, no matter how good of a trader you are, and you'll get more comfortable with dealing with loss and seeing loss. Never trade with money that you can't afford to lose. If you can mentally detach yourself from the money you're trading with and already consider it gone before you buy anything or buy an option contract or buy shares, if you consider that money already gone and you're completely fine with losing it, it's not going to make or break you. Then once you lose it, well, who cares, right? You've already lost it. And that boils back down to, focusing on the trade itself and not the money. Everything goes hand in hand, and you'll really start to understand how this system and the way in which I'm going about breaking down my system is only going to work if you take the time to really, I hate to say it, well, suffer through, a lot of the learning curve, which it's going to take time to learn this stuff. It doesn't matter if I explain it, if I teach it, it's still going to take you time. I'm hoping that we're going to speed up this process because I'm giving you this information and really taking out all the fluff, not giving you any of the nonsense that might otherwise be out there to distract you. So it's going to take you time. Put in the work, put in the effort, work on your trading psychology, and you will become a successful trader. If you've made it this far in the video, I know you want to take trading seriously. So what I want to do is I want to give you a 15% off discount code for my mentorship group. Now, the discount code is right here on screen. So all you have to do is click the link in the description below, head over to my mentorship group website, apply that discount code, and that will give you access to the mentorship group for 15% off. I hope to see you over there, and let's continue on with the free training. Trade journals are vital to your success as a trader. Please don't take this video as any less valuable than the others just because it's short. What I want you all to do is go ahead, grab yourself a journal, a notebook, a piece of paper, do it on the notes in your phone if you want, but I need you to start logging your trades. Now, every day after the market has closed, I want you to go ahead and write down every single trade you made throughout the day. Here is how I want you to format your trade journal. You're gonna start by just putting the date. I believe today is the 22nd and it is 2021. Put that up in the top left or whatever. And then next, you're gonna write down the ticker symbol, okay? And then whatever that is. So say you're trading Microsoft, so M, and maybe you traded Bank of America, so BAC, maybe you traded Walmart, WMT. So essentially what you're doing is you're just logging the trades you've taken. You want to write a couple things down for each trade. I would write a little summary of the trade, so why you entered, all right, what the idea was behind that trade, and then if you exited, why you exited, so entry slash exit. Did you close for profit or did you have to cut at a loss? So we'll say profit loss. And if you'd like, you can log, how much percentage or dollar value you gained or lost. We're not trying to focus on that, but we want to just be aware. So we're keeping track. This is part of our bookkeeping. Again, just like a business, which it is, trading is your business. You have to have bookkeeping. So, you want a little summary of the trade. If you entered or exited that day, why you did, was it at a profit? Was it, for a loss, depending on, what happened with the trade? what dollar or percentage value was that profit or loss. If it was for profit, I want you to write down a couple of reasons why you think the trade worked. Okay, so why, and if it was at a loss, I want you to write down a couple reasons why you think the trade didn't work. Okay, so why profit or why loss? Sorry, this is super messy. I should have left myself more space. Now, I want you to do this for each trade. You should be examining these trades. You have to do this at the end of each day. If you took a loss on that trade, you want to examine the trade and know why. And if it's something that seems like you could avoid in the future, well, there you go. What you can do is tomorrow morning, go back and look at that trading log, remind yourself, well, this is something that yesterday I messed up on, or not messed up on, but something that I have learned from that I don't want to do again. So today when I'm heading into my trading session, I'm going to be aware not to make the same mistake I did yesterday. We're looking to make improvement. Now that is the idea behind logging your trades. It's not as important as how much you made or how much you lost. It's more important to figure out why, okay? Why did you make money? Why did you lose money? Summary for BAC, Walmart, have your trades. And then if you'd like, up at the top, you can write whether it was a green day, okay, or a red day. By keeping track of our trades, logging our trades every day, we are looking to answer 3 different questions. Okay, so our goal is going to be increasing performance. So our first question is going to be, how can I make more money from my winners? Okay, write that down. How can I make more money from my winners? Second question, how can I lose less money from my losers? How can I lose less money from my losers? And the third question we're trying to answer, or more or less figure out, is how can I get more trade ideas? So I have adapted these 3 questions by reading a couple books and listening to some other traders, because these are 3 questions that they had been asking themselves, that I started asking myself. And when I started my trade journal and logging my trades, this is something that I have adapted and I have found effective. So now I'm sharing it with you guys. I didn't invent this system as far as these 3 different ideas. It's something I've adapted. So the first 2 are pretty self-explanatory, right? We are trying to figure out on our winners, why were they winners? What worked well? And then for our losers, why were they losers? And how can we not do that again? All right? How are we going to lose less money on those losers? How are we going to make more money on those winners? As far as making less money, maybe you identify something that you've done wrong a couple times, and when you're writing your summary, you want to put in a good amount of detail, what happened, where your stops hit. Did you lose this support level that you thought was going to hold? You're trying to identify and narrow down. Next time, once you go to enter a trade, how can you avoid doing that? Or how can you get better at doing whatever it may be that you're doing well? So number 3, how can I get more trade ideas, is similar to number 1 in the sense that when you are logging what it is that you've done right, you're going to see things that you're doing on a regular and a consistent basis that are working for you, that now you have identified these things. You're going to be able to take those, adapt them, and implement them into your trading. Okay, so I hope that makes sense. I know that third one can kind of be confusing, but you're really trying to identify what is working for you. Okay, so once you've been able to see that you have been doing things multiple times and you're noticing patterns within your trading, within the profitable side of your trading, okay, so number 1, then you're gonna go and start to implement these ideas into your trading. And again, the goal here being to increase performance. So go ahead, get yourself a trading log, a trading journal. Every day after the market closes, log all of your trades. Do this every single day. Don't miss a day, stay consistent. You're gonna use this data to continue developing your trading system, or this system that I have given you that you're gonna make adjustments to, right? This is my trading system, but you will develop your own ways of going about my trading system. And by logging your trades, that is another form of working on growth mindset, becoming a better trader, and ultimately striving to become a profitable trader in the long run. How do you go about managing a trade once you've entered? I'm going to give you a couple of helpful tips. The less thinking you have to do in the moment, the better. And not just that, but the less emotional thinking you have to do, the better. You should never trade with emotion. So having a plan that you've already established beforehand is going to remove any of that emotion you might be dealing with in the moment when you see your, portfolio going up and down. So just make sure you have to process as little information as possible. And that is by having a really solid trade plan ahead of time. My second piece of advice is going to be don't micromanage. Now, you're going to have the urge to continue looking at your trade throughout the day, to keep checking on it. Now, if you start second guessing yourself, you're going to start doing anything you can to justify what you're thinking. You're going to start looking on different time frames and even putting in new indicators and moving averages. So the best thing to do is to not micromanage, to not keep checking on your positions, just to let your position sit there. Okay, shut off your phone, walk away from your screen. Don't keep checking on it. So place your trade and walk away. I like to saying, set it and forget it, okay? Set your trade, enter your trade, and forget it. As long as you have a solid trade plan, there's nothing that you should have to worry about. And of course, just don't second guess yourself. There's no need to second guess yourself. Have your plan, enter your trade, don't micromanage, don't keep looking at each tick, don't start looking on different time frames to justify whatever you're thinking in the moment. Don't second guess yourself. Set it, forget it, and walk away. That's some great advice when you're already in a trade, how you're going to go about letting that trade pretty much play itself out without letting your emotions get in the way. Once you've established a solid trade plan and you've entered, there's nothing else you have to worry about. Set it, forget it, and move on. All right, that is it for this quick lesson. Go ahead and move on to the next one. All right, as you can see, in this lesson, we're going to be talking about goal setting. Goal setting is important because you want to constantly be improving and working on yourself as a trader. Maybe you are a profitable trader or you've found some level of success, but you want to continue improving and maybe you haven't been able to make money yet. So your goal is going to be able to do that. But I think the way in which I approach goal setting is unique. I'm going to break down the structure in which I go about setting goals for myself, and you can go ahead and implement that into your own trading, into your own goals. Don't set a goal based on making a certain amount of money or losing a certain amount of money. Now, this is why, and you're gonna see how we continue coming back to the topic of not focusing on money and of not focusing or trading your P&L. When you put your P&L or your gains front and center as far as a goal, it is gonna distract you from actually hitting that goal. So don't have a fixed P&L goal. Here's how I go about setting goals and how I initially started to set goals when I was learning how to trade. Small wins, okay? This is the key here. Small wins. What do you need to do to go from where you are now to hit your goal? Well, you need progress. Instead of saying, I want to make $4,000 my first month, what you should be doing, start by setting the goal of losing less, okay? So you want to lose less. It's pretty simple, but losing less is a great step forward, and it's a great step towards maybe your ultimate goal of making $4,000 a month. I don't want to contradict what I said earlier because I still mean what I said. Don't have your P&L front and center, but you still want to have some idea of where you're at so you can tell if you are making progress. So the first step is just going to be to lose less. Or we could even say before that, you are losing a lot. So you want to go from losing a lot to losing less, right? It depends where you are in your trading. So let's say you're losing a lot. I'm just going to put it up here. So you're losing a lot. So that means your goal is going to be, well, lose less. And then let's say your next goal is going to be to trade flat. So you went from losing a lot, which I would say is where most people are going to start. Okay, so losing a lot to losing less to trading flat. And now where do we want to go next? Well, what's after trading flat? We're going to make profit. So make profit. Losing, I don't know how this got so messy, but write this down, okay? You're losing a lot, and then the goal is to lose less, and then to trade flat, and then to make profit. So we're taking incremental steps into hitting what is our eventual goal of making money, okay? That is the underlying foundation of why you're trading. You want to make money. And these goals are much more meaningful than saying, I just want to make $4,000 a month, or I want to make 20% a month. We want to look at our progress and take small steps. So this is called my small wins goal setting formula, if you will, okay? So small wins, lose a lot, lose less, trade flat, make profit. That is how you should approach thinking of goals. Losing less is a huge improvement from losing a lot, just as trading flat is a huge improvement from, well, you know, losing money. You're still losing, but once you're trading flat, you've reached a point where you have found a level of consistency. You might not be in the profit, but at least you're not losing money. So that is progress. And then eventually you'll get to the point where you're making profit. Okay, so that is how I went about setting up or structuring how I approached goals when it comes to trading. And I'm sure you can apply this similar concept for other topics or subjects in life. Incremental steps into achieving a larger goal. And the next topic I'm going to be covering is growth mindset. Now, growth mindset is going to be very important for us traders. I was listening to another trader speak, and the way he put this really made sense to me, and I can't remember his name, but he said if you come into trading with the mindset that your talent alone is going to make you money in the market, then you have what is called a fixed mindset. Now, I'm not sure if I should have covered this before. I just talked about the goal setting. If you come into the market and instead of having a fixed mindset, instead if you come in and say, I'm doing great today, but by setting these goals and following these goals incrementally, I am slowly but surely going to become better. I'm going to be better tomorrow than I am today because I'm going to be working on my edge. I'm going to be working on hitting my goals and getting better. Versus that fixed mindset that you come into trading, oh, I know this, I know that, I'm just going to do that. And I'm not going to work on improvement. I have a fixed mindset. So that growth mindset is key. Do not have a fixed mindset. Don't think that you know everything. And kind of bouncing back to what I talked about earlier is, especially if you've come into the market and you've had that beginner's luck, and now all of a sudden you have shut down to learning anything new because you think that you have already figured it out. Now you have a fixed mindset and you think you have this talent, right? And with that talent, you're fine. That's a fixed mindset. Don't have a fixed mindset. You got to switch out of that. You have to say, yes, I've done well. I recognize that what happened was most likely beginner's luck, and I am going to set goals and work on achieving those goals and improving. Growth mindset and goals tie in together. The concept of I'm losing right now, the next incremental step towards achieving my underlying goal of making money is going to be losing less money and then trading flat, and then you're going to be in the profit. So take trading one step at a time. Don't get overwhelmed. Don't set a goal or an unrealistic goal based on a dollar value or percentage value, and never trade based on your P&L. I am going to explain to you my approach in figuring out where I'm going to put my stop, where I'm going to put my TP, my target profit, take profit, whatever you want to call it. Now, what I want you to do is think, where are most people going to be putting their stops? Now, typically people are going to be looking to cut loss, put their stop loss at either a major support level, at a moving average, whether it's the 50-day SMA, the 180-day SMA, the 15-day EMA. So we're trying to think about where most people are going to be putting their stops And we don't want to do that. Again, we're trying to approach the market in a different way than the majority of traders. Just for an example, KLAC, depending on the setup you've identified here, the overall market condition, varying chart patterns, there's multiple things to take into consideration. But just for this example, let's assume that we have a bunch of positions open. Now, where do you think that those people are going to be looking to exit that position if we did start to sell off? Overall, we can tell this 180-day SMA has acted as support. What you need to understand is that most people are going to be putting their stops on this level. Again, we're trying to think about what most people are doing. Most people are going to be putting their stops on the 180-day SMA on a major support level. And we're going to also apply this same concept to where people are putting their targets for when they're going to take profit. And again, that is going to be these moving averages, or these very clear, in that case, a very clear resistance level. So everyone's going to be putting their stops at this level, at the 180-day SMA. We don't want to put our stop there. And I don't want to sound like I'm contradicting what I'm saying, but there's an exception to every rule. And depending, like I said, on market conditions, on the chart, there's many variables that you have to take into consideration. But generally, we do not want to put our stop where the majority of people are going to be putting their stops. Everyone sees that same 180-day SMA. Everyone sees the same support and resistance levels the chart has formed. All right, so why don't we want to place our stop at that level? Well, what happens is people get stopped out. Okay, say price pulls back, we hit this level, everyone gets stopped out, we drop below, and we might even start trading below the 180-day SMA, for a little bit, as you can see we did here. But then very often, almost all of the time, you'll see that the price remounts this level. And you can see where this happened right here. Think about how many people had their stop set at the 180-day SMA. Yes, we did sell off a little further, but we ended up remounting that level. Okay, this is a lot of chop, but if we scroll further down the chart, there we go. You can see again, we lost this 180-day SMA. Everyone got stopped out. We remounted this level and then started trading higher. I made this example pretty clear, but essentially what we're doing is trying to go about seeing the market in a different way than the majority of traders. The majority of traders aren't profitable, so why are we going to want to do anything that the majority of traders might be doing? We want to do the opposite of what the majority of unprofitable traders are, so we can be in the minority that are profitable. Like I said, the same concept applies to when you're going to take profit, and depending on the chart, the market environment, there's always an exception to the rule. You might not always use this concept, but it's very important to understand that generally, you don't want to do what the majority of people are doing. Now, I really hope you guys are starting to get a greater understanding of how you can see the other side. Now, when I say the other side, you want to understand how buyers and sellers are interacting within these charts, within these levels, these moving averages, within support and resistance levels, and you need to start thinking on your own. You need to start thinking in the minority, not in the majority. That is going to wrap it up for this lesson. I will see you all in the next one. Today, I'm going to be talking about how you can increase your trading win rate with this tool that I made. Now, I call this the ADR calculator. Now, ADR stands for average daily range. A couple things I want to mention right off the bat. Unfortunately, this is only for traders that are using the ThinkorSwim platform, which is what I'm using today. Secondly, this only works, when trading on the 4-hour time frame, 4 hours over the last 180 days. So the 4-hour 180 day. Make sure you have this time frame pulled up, 180 day, 4 hour. That's the only way this is going to be accurate. All right, with that said, why will this ADR calculator help you increase your trading win rate? Now, I've been trading for many years, and one of the things that I realized right off the bat, not just in my trading, but when working with students, is that what tends to happen is that we set these targets, whether those are our take profit levels or our stop loss levels, right? Whether we are long or short, doesn't matter, but we're setting these levels based off of something we see on a chart, okay? Whether that is a moving average or a support and resistance level, a key level, maybe you're just looking at the candlesticks and you're setting that target that you're looking to hit or looking, at that point to get out of the trade, right, based off of that trade specifically. The problem is traders, including myself in the beginning when I didn't have this tool, we tend to set unrealistic targets. Now I'm going to explain what I mean by that. So here's a little summary. Using the average daily percentage movement and its projections, you can gain insights into the historical volatility of a stock. Okay, so this information can essentially be valuable for setting realistic stop loss and take profit levels based on recent price action. Okay, so average daily range, ADR, that is this tool right here, okay, that I've plugged into my ThinkorSwim. It is the average daily percentage movement, which will give you an idea of how much the price typically moves in a day of that specific stock you're looking at over the last 180 days on the 4-hour time frame. Okay, this information can be used to decide whether your stop loss or take profit will actually be hit within your optimal trade hold period, okay, mine being 3 to 5 days. So up here you can see over the last 180 days, the stock specifically that I'm on is ticker symbol CRM. So over the last 180 days, CRM has on average moved 0.85% a day. Now that's not up, that's not down, that is just taking into account the daily high and the daily low on the 4-hour over the last 180 days. So between the lowest price of the day and the highest price of the day, on average, okay, CRM specifically is moving less than 1%. Now, when it comes to setting those realistic targets, I'm going to give you an example. So if let's just say this is just a theoretical trade, right? And don't even look at the chart. But okay, let's say your take profit sits 8% away, okay? And your average hold period is between 3 to 5 days. Yet the stock you're looking at only moves on average 0.50% or 0.5% per day, right? Which we'll be able to see based off of the white box right here, okay? So say that stock you're going to trade, it only moves 0.5% a day, yet you set your take profit 8% away, which means, looking at the chart, that stock has not moved 8% in 2 weeks. Well, then you shouldn't be taking that trade, okay? Because you're not going to hit that target within your optimal hold period. And part of trading is setting realistic stop loss and take profits. Okay, that's vital into your success because we need to run the risk to reward beforehand, okay, based off our stop loss and take profit. And then we can simulate the expected returns around our average hold period and figure out if that's a trade we should take in the first place or not, okay? So by using the ADR calculator correctly, you should start hitting your targets and see an increase in win rate. I'm going to give you some examples. If this doesn't make sense, don't worry. Now, because my optimal hold period, that means when I'm entering a position to when I'm selling that position is in between 3 to 5 days, and the longest I'm going to end up holding a position is going to be 5 days, then I want to set, when I go to simulate that trade out, the furthest out I'd end up holding a position. Okay, that is going to be essentially the worst risk to reward. So on the first day, say the next morning, if I hit my stop loss or take profit, I will be presented with the best risk to reward. But as the days go on, as we trade options, well, theta kicks in and it costs us more and more each day to, hold that position. Okay, so that's why I'm going to go 5 days out when I go to run that trade to simulate out that position using the Analyze tab. Okay. All right, so like I said, I'm going to give you a couple examples, but I wanted to show you real quick. If you go up to the gear icon, go up to the studies icon, you can see here, we've obviously got our studies applied, our SMAs, our EMAs, and you can see here the daily traders ADR calculator. Okay, now, once you've installed the calculator, there'll be a link below this video. All you have to do is click on that link. It'll take you to a website. It'll be ThinkorSwim's website. You just click import, and then it'll load, and it'll be in your ThinkorSwim. So it'll be under studies. So you'll be able to look up the daily trader's ADR calculator. If it doesn't automatically apply to your chart, it'll pop up. Click on the gear icon. Now, the length has to stay at 180 days, okay? It doesn't have to, actually. I like keeping it at 180 days because that gives me like the most accurate representation. But if you do your work on another time frame, or not time frame, you got to stay on the 4 hour, but you could go 60 days, right? Okay, and you can hit apply. But it's not going to change a whole lot, right? Maybe, say in the last 2 weeks, the stock's been super volatile. Maybe there was earnings, just some abnormality, okay? We can change that length. Oops. Okay, I changed the wrong thing. That's funny. I changed my EMA. It has to be 180 day. Okay. Length, let's say 60. Okay. Apply. Okay, 0.87. So it's virtually the same. So I would just recommend, even though you have the flexibility to change it, I would recommend staying on the 180 day. Again, it's just a larger time frame. But we can look at, like, say, the last 10 days. Okay, our average daily range over the last 10 days is 0.96. Okay, but that's up to you. I'm just saying the way I use it, it's looking over the last 180 days. Okay, half a year worth of data. And then this is a user-defined day. So because my average hold period is between 3 to 5 days, I'm going to go the furthest out when it comes to simulating that position, running that risk to reward. Say your average hold period is 3 days. You can hit 3. Say it's 10 days. We'll hit 10, click OK, click Apply, and OK. Now, up here, the 10-day projected movement is 8.48%. You can see how that changes. Back to studies. Let's just switch it back to 5. Let's just use 5 days. Okay, 5 days. Apply. Okay. Now, let's go choose a stock. Let's say we are just, this is totally a theoretical trade, okay? We are going to trade ticker symbol CSX. Let's say our take profit is going to be at 35.83. Our stop loss is going to be at 37.37. We're looking to see a pullback to the 50-day SMA. Now we can look at the average daily range on CSX over the last 180 days is 0.76%. Now the 5-day projected move is 3.7%. That means that our take profit and our stop loss have to be within 3.78%. Okay, I guess it can be a little over, right? But if it's like 5, 7, whatever, 10%, that's the, our stop loss. So when you go to drawings and you click on the drawing tool, the timeline, and you drag this from where we're currently trading, which is around that 37 area, up to our stop loss. All right, 0.70, we're within that 5-day projected movement. And then let's look at our target. Okay, 3.3, we are in our 5-day projected movement. That means now, obviously, we can go punch in 35.83 in the Analyze tab to run the risk reward, and 37.37, knowing that that is a realistic target to hit within, 5 days, our projected move. So that is how your win rate will increase. Now, let's say, for example, you set your take profit down here at the 180 day. And we can see based off of this stock, right, that the average or the 5-day projected is going to be 3.78. Well, if we drag down to this level, we're sitting 7.4% away. Okay, our target's 7% away. Now, are we going to hit that target realistically within 5 days? No. Now, on the other hand, maybe your average hold period, the longest end of that is 15 days. If that's the case, now it looks like you could take that trade, right? So, a couple of things you should, understand is that you need to have this data tracked. You need to know what your average hold period actually is. Okay, whether that's 1 to 2 days. This only works from a swing trading perspective, okay? But 3 to 5 days, 7 to 8 days, whatever the case may be. And so you could start setting those realistic targets. Let's give you guys another example or two. Let's find a different looking chart here. Let's find something a little more clean. I don't know why that keeps popping up. Okay. Nah, that's not a great example. Let's find something. Okay, please stop popping up. Let's see. Let's go for, I'm trying to find one of our setups here. Let's see. I like this one. Okay, so let's say we're just going to look to capitalize on a pullback. This is just a theoretical trade. Back down to that low. We're going to set our stop loss at the 50-day. Okay, just theoretical. Now, if we look at this stock, specifically BKR, average daily range is 1.17%. Our 5-day projected movement is 5.85%. Okay, so from where we're currently trading, let's calculate the margin for profit down to our take profit, just about 8%. So that would not be a realistic target to hit within those 5 days, which means that trade we would end up holding more than likely beyond those 5 days, where at that point we haven't accounted for that risk to reward as the days progress, as that position gets more expensive to hold. Now you could be in that trade for a week and you're not going to hit your target. You're going to have to get out. There's going to be a decrease in win rate. So if you can set realistic targets by using this ADR calculator, it is almost inevitable, not guaranteed, but almost inevitable that your win rate will increase. Now, obviously, our stop loss is good, okay? Let's give you guys one more example, okay? And then you can start using this yourself, start seeing an increase in that win rate. Super theoretical, let's say that low at 175.01 is our stop loss. And our take profit, let's say, is up here at the 196.60 area. Okay. Now, currently trading at around 189.30. Stop loss is sitting 7.6% below. Good. Okay, we're within that 8.02%, the 5-day projected move. And our take profit is within 8% as well, 3.7%. Realistic targets. We're either going to hit that stop loss or take profit right to the most of our knowledge using this tool. Like this is theoretical, but looking at historical data, using that as a projection into the future, we can assume that we'll hit that stop loss or take profit within, in our case, that 5 days, right? Or in my case. Okay, so again, just, if you guys want to take down a couple notes, I'll just pull back up CRM where I had my notes. If you guys want to write this down, I think at this point it should be pretty straightforward. Again, you just click the link below. It'll take you over to a website. It'll be like ThinkorSwim. You just hit like apply. It'll load that tool into your TOS account. And then again, under studies, the Daily Traders ADR calculator, click on that, click on add selected. I'll show you guys how I have it applied because it looks nice and pretty and it won't look like this right away for you. So let's see. Okay. Gonna look it up here. Click on the Daily Traders ADR calculator, add selected. Now, click this arrow because if I apply, you'll see, there we go. Now, if it was like this, when you applied it, it would look like that. So we don't want it to look like that. So you gotta click this arrow, move it up. Now it should have that sign, okay? You can move it up again, totally doesn't matter. Click apply. Now it's here. Okay, now it's got this like annoying like border. Okay, let's change that. So let's go back to here. Let's go to Daily Traders ADR Calc. Let's click on settings. And then left access, we're gonna uncheck. And again, this is the length. I recommend keeping it at 180. Again, this has to be used on the 4-hour time frame. 180 days is gonna be gonna give you the most accurate representation of that average daily range and the projected move. This is your optimal or average hold period and the longest end of that. Okay, so on average, you're holding a trade 6 days. So 6 days. Okay, apply. Okay, there you go. That is the ADR calculator. I'm constantly working on building out new tools and ways to help you guys not only find that consistent profitability within the stock market, but squeeze the most you can out of your trading system. So from a win rate perspective, this should really help you guys out. Hope you guys enjoyed. Okay, see you in the next lesson. Congratulations, you have officially made it to the options section of the course. I'm going to be talking about what options are, what to call, what to put, how to execute an order, how to actually trade options. So here's the definition of what an option is. In finance, an option is a contract which conveys its owner, the holder, the right but not the obligation to buy or sell an underlying asset or instrument
at a specified strike price prior to or on a specified date, depending on the form of the option. If that sounds confusing to you, don't worry. I'm going to give you an example. An option gives you the right to buy 100 shares of a stock. Options give you this crazy leverage that you would otherwise not have. For example, if you buy 100 shares of Microsoft, that's going to cost you $22,200. Now, on the other hand, if you buy one contract of Microsoft, it's going to cost you $445. I never recommend as a beginner that you start with options. Yes, it gives you the ability to make more money with a smaller portfolio, but in return, you're taking on that much more risk due to this leverage. You're getting really 100 shares of the company you're buying for a fraction of what it would normally cost. Although I encourage you to see what works for you. Again, there's no cookie cutter formula you can follow. See if you like options. So my bread and butter is option swing trading. I'm able to identify these setups within a larger trend, and I trade these trends, these patterns with option contracts. All right, let's talk about calls versus puts. What's a call? What's a put? Because you're either going to be buying a call or you're going to be buying a put. Now, a call means you think the price of the stock or the underlying asset is going to be going up. Quick side note, you can buy options for a bunch of different stuff. I'm talking about stock options. This lesson is to do with stock options. So call, you think it's going to go up. A put is the opposite. So you think the price of the stock or the underlying asset is going to go down. So a call is bullish. You think the price is going to go up, and a put is bearish. You think the price is going to go down. So this screenshot is an options chain. Now this is TD Ameritrade's ThinkorSwim platform, the platform I use to trade. Now, it's going to vary. I'm going to talk about this later, but it will vary on what brokerage you're using, on what platform you're using to place your trades. So it might look a little different. I know Robinhood looks different, but I will show you an example of that later on in this video. In this next lesson, I'm going to go over these different columns and I'm going to show you how you actually buy an option. But there's a couple more things you're going to need to know before you make your first options trade. And that is in the money, ITM, versus out of the money, OTM. I'll show you what in the money and out of the money looks like on Robinhood's platform and TD Ameritrade's platform. And I'm sorry if you have another platform that's not one of those, but there's dozens and I just don't have time to cover every single one. I'm using Microsoft as an example. As you can see, the current price is $222.50. That is this share price right here. Now, this is a call. So if I'm going to be buying a call in the money, that means I want to be buying an options contract. Now, that's what these are. So in the money is going to be anything below $222.50. So any of these contracts, the $220 contract, the $217.5, or the $215. These are all in the money. Okay, so what is an out of the money call? Now that is going to be anything the opposite direction, anything above the in the monies, which is going to be anything above $222.50. These are going to be out of the money. The 225, the 227.5, the 230. Okay, so that's going to be if you want to buy a call. That's in the money, that's out of the money. So that's for buying calls, but what if we want to buy a put? Again, a put, you think the price is going to go down. So an in the money contract for a put is going to be on this side. It's going to be anything above the 222.50. And then anything below the 222.50 is out of the money. So in the money, out of the money. And then if we hop back over to the screenshot of ThinkorSwim, the left side is going to be calls and the right side is going to be puts. As you can see, put and then call. The contracts in blue are going to be in the money and that's a call. So these are in the money for calls. And this bottom section right here is going to be out of the money. Right now, all you have to focus on is the middle column. We've got the strike price right here. And then we've got the expiration date. The contracts in blue are going to be in the money, and that's a call. So these are in the money for calls. And then this bottom section right here is going to be out of the money. Just the opposite on the other side, puts, these are going to be in the money, and then these are going to be out of the money. All right, let's talk about the options format and how you actually read an option. So it's going to be displayed like this. There's going to be the stock, so Microsoft, the strike price, whatever price you think it's going to be, whether it's a call or a put, and then the expiration date. For example, the Microsoft $235 calls expiring on January 29th, 2021. This pretty much means that you think Microsoft will be at or above $235 on the 29th of January. Okay, so that is the very basics of options. What are options? Calls versus puts, how you actually read an option, how it's formatted, and then in the money versus out of the money. Now I'm gonna go ahead and hop in TD Ameritrade and show you exactly how to buy an option. All right, let's dive into how you actually go about buying these options. Even though it might look different on your brokerage platform, everything still applies. So I'm going to go into the option chain, and we've got right here our expiration dates. This might look kind of overwhelming. I just want you to focus on a couple of things. In the middle, right here, we've got our expiration date. These are the January 22nd calls. As you can see, I picked right here. And then on the right, we've got our strike price. For example, $220, $222.5, $225. On the left side, these are calls. And then on the right side, these are puts. So the market's closed, so these numbers aren't going to be changing at all. It makes it kind of easier actually to talk about it if the prices aren't constantly changing. Last is the last price someone paid for the contract. The bid and the ask, these are the price of the options contract. And then we've got on the other side the same thing, but again, this is for puts. All right, so how do we actually know what the value of these options contracts are? If we look under the ask and the bid, we can see that there's some prices. This contract isn't $26, it's $2,620. Don't worry, you'll get used to it. That's just how options work. So the options contract value has nothing to do with the actual price of the stock. This option costs $705. All right, and then we've got the in the money and out of the money for calls, and then for puts, in the money, out of the money. For example, say I think Microsoft is going to go up to $230. Now you're probably thinking, oh, I'll just go buy the $230 call, which would be $3 or $300. But what I always do, and I know I mentioned it briefly, is buy in the money. Now, options trading is one of the most risky things I think you can do when it comes to trading in the market. It's very risky, again, due to the leverage you get, and your contracts can lose value very quickly if you're not careful. When I started options trading, I would buy out of the money, far out of the money because they were cheaper, and I was trading with a smaller account, and I would buy a very close expiration date. Again, it was cheaper and I didn't know what I was doing. I found out that was a really bad idea. I was actually on my way to work and I was looking down at my phone, and this is when I had just gotten into options. I looked down at my phone, and instead of seeing, positive whatever, it was like negative, I think 90% on my new options contract I had just purchased the day before. So that was a bit of a shock to me to see how fast you could go and lose all of that money. That was the kind of turning point where I'm like, well, I need to educate myself. I need to actually learn how these options work. I saw how fast you could lose 90% of your money in just a couple of minutes. So that got me really curious. Well, if I could lose 90% of that money I had put on that contract, could I also make 90% of that contract's value, within a couple minutes when the market opened? I still made the same mistake several times, and it really took me a couple months to understand how this worked. So I'm going to try to explain it as simple and as straightforward as possible. The value of an in the money contract is going to be exponentially more than the value of an out of the money contract. That is because you're betting on the price going up just that much more. So the value is not there at the moment, but it could potentially be there in the future. That's why buying an out of the money call, you're able to make a lot more money, but they're also cheaper. So it's riskier, but it's also more rewarding. My goal with this course is to not just show you exactly what to do. I want to give you some tips from my experience and what I've learned. Now, what I learned was if I'm going to put so much risk up front when I buy these contracts because it's options, I'm leveraging my money so much more than just buying a normal share. I have to do everything in my power to minimize that risk and minimize the chances of myself losing money in case things went the wrong way, like they did that first morning when I opened my phone and looked at my portfolio. And yes, it's going to cost a bit more to buy an in the money call with a further out expiration date. Two things: you buy an in the money call and you buy a further out expiration date. I'm going to get into why the expiration date is important, and that has to do with the Greeks, specifically theta. Now, don't worry about that. I'll talk about it in the next lesson. Just know that you want to choose an expiration date that's more than 2 weeks out. I personally always buy contracts at least a month out. And besides the Greeks, this will just give you enough time in case it does go the wrong direction and you lose a good majority of that contract's value. It'll give you that much more time for the stock to turn around and to gain the value of that contract back. So today is the 2nd, and say I think Microsoft is going to get up to $230. I'm either going to pick the 29th of January or the 5th of February for the expiration date. So Microsoft is currently at $222. This would be the $230 call. Currently, it costs $5.15. I'm going to be looking at something further in the money. I like to go 1 to 2 contracts in the money in case the price pulls back a little in the near term. I'm going to keep most of that value. So I'm going to go with the $215 call for $12.95. I'm going to click buy. Now we're going to get the opportunity to buy this actual contract. And right now it's automatically going to set it to a market order. Now market order is going to fill you at pretty much the worst price possible. You're going to end up paying a lot more than you should. So I'm going to go ahead and change that to limit. Now this is very important. Change it to limit order. I don't want to pay $12.95. I'm going to head down here. So I'm going to choose somewhere in the middle between $12.55 and $12.95. So by doing that, I'm going to get filled $20 lower on this contract. Now, if you were buying 5, well, that would have been $100 you would have just wasted if you had missed this little step. Now, it's not guaranteed that you're going to get filled at this price that you're asking to get filled at, and you could even try getting filled lower. I recommend going somewhere in the middle, finding a happy medium. And then once you've done that, all you have to do is hit confirm and send. That is how you buy an options contract. Very straightforward. Same thing applies if you're going to buy a put. It's going to be even easier if you're using Robinhood, and on every brokerage, you still will have the ability to place a limit order, and I highly recommend you do that. So everything I just went over, the same thing applies to the other side, which would be puts. All right, let's move on to the next lesson within the Options 101 segment. What is up, team? How's it going? In this lesson, I'm going to be talking about options, specifically Greeks. Now, what are Greeks? How do they work? And how are they going to affect how you're able to make or lose money on that option? Before we get into that, I just want to go over the bid and the ask again. So the bid is what buyers are willing to pay for the option contract, and the ask is what sellers want to sell the contract at. So in between $12.10 and $12.95, that is the spread. Now this is a pretty large spread. So when you're trying to get filled, you see the little slider right here. You want to choose somewhere in between that price. So maybe somewhere like 820. So it just depends. And again, these are in the money calls, out of the money calls, in the money puts, and out of the money puts. All right, I'm going to use this contract for the example. We've got Delta, Gamma, Theta, and Vega. So Delta is 61 cents, so $61. So think about it like this. If Microsoft moves up $1, this $11.25 contract is going to go up by 61 cents. Same thing applies to these contracts, except Delta is now 65 cents. So every time Microsoft goes up $1, these contracts are going to increase by 65 cents. Again, this applies to all brokerages. You just might have to figure out where the Greeks are actually listed depending on which brokerage you're using. All right, I just want to make sure you guys fully understand Delta before we move on. So if the current price of the contract is $12.95, we're going to do $12.95. And if Microsoft moves up $1, we're going to add 0.65. All right, so $65 to the contract, 0.65. So $13.06. That's how much the contract is going to be worth if Microsoft moves up $1. Gamma is not as important, but it follows, or it's almost connected to Delta. Now the second dollar move, if Microsoft moves up another $1, it's going to add Gamma. So Gamma right now is 2 cents. All right, let's use this contract as an example. So it currently costs $12.95. So the first dollar move is going to add 65 cents onto these contracts. The second dollar move is going to add another 65 cents. Okay, but this is where Gamma comes in, plus 2 cents. So plus 0.2. So now the contract's going to be worth $14.27. I'll give you another example. If we look at the $9.85 contract, it's going to be $9.85 plus, let's look at Delta. So $9.85 and Delta is 56 cents. So plus 0.56 plus another 0.56, right? So that's going to be the second dollar move is going to be Gamma plus 0.2. So now these contracts are going to be worth $10.99 on the second dollar move. I hope I simplified Delta and Gamma enough. I know that can be pretty confusing, but let's move on to Theta. Now, Theta is the most important, in my opinion, out of all the Greeks. So every day it's going to cost you a certain amount to hold that option. So if we look under Theta and we're going to look at the $12.95 again, for the $12.95, every day that you hold this contract, it is going to cost you 11 cents. Okay, so $11 every day to just hold. This is not really going to happen, but if for some reason Microsoft opened up the next morning at $222.42, and it did not go up at all, you're going to lose $11 of the value of that contract. But if Microsoft goes up, it's going to equal out and you're going to end up either breaking even or you're going to make money depending on how much Microsoft goes up. But if the stock goes down, you're still going to be paying theta, and you're also going to be losing whatever value that contract lost due to the decrease in stock price. So going back to earlier when I said I always choose options contracts with a further out expiration date, well, this mainly has to do with theta. Okay, if I look at a closer expiration date, let's look at the January 8th calls. So for these calls, theta is going to cost 23 cents. I've seen theta be as much as $300 to hold it overnight. So again, it comes down to risk management, managing your risk. When you're playing options, you're not going to choose a close expiration date. You're going to choose something a month or so out. So it's not going to cost you so much to hold these contracts each day. Also, if the stock does not go in your favor, it's going to give you more time for it to get back to that price. So if the value of your contract goes down because the stock goes down, well, you've got more time to hold that contract and wait for the value to go back up. Well, at the same time, it's not costing you much to hold it every day. So minimizing risk as you're playing options, that's the smartest thing to do if you're going to play one of the riskiest games in the market. And the last and final Greek is going to be Vega. All right, so Vega is something you're not going to have to really pay much attention to. It's just the implied volatility. So Vega is going to be affected by fundamentals like news. If an article comes out about the stock, that is going to affect Vega. But otherwise, Vega, you're not really going to have to focus on it that much. That's everything you're going to need to know. I wish you all the best of luck trading options. Don't forget to do your part in managing risk. Spend a little more money to buy further out expiration dates and further in the money calls. All right, team, that is it for this lesson. I will see you in the next one. What is up, team? How's it going? I hope you guys are enjoying the course so far. Just a reminder, make sure that you're taking notes. A lot of these topics are pretty lengthy, so taking notes, watching the videos a couple times, it's really going to help you understand these concepts that I'm going over. But in this lesson, I'm going to be talking about the ThinkorSwim Analyze tab. So unfortunately, if you do not use TD Ameritrade's ThinkorSwim platform, you will not have access to this tool. Now, this is a great tool that I use to calculate the value of my options in the future. This is how I go about setting up my trading plan when I calculate my risk management. It's an important tool. It's not necessary. It's a tool I use, and that I'm so shocked I have never seen anyone talk about it, okay? Never on YouTube or anything like that. So I really think if you have TD Ameritrade, take advantage of this tool, okay? I used to be so blind to the fact of, well, when you buy an option contract, you pretty much have no idea what the value is going to be at the next day. But this tool essentially lets you calculate, well, the exact price at which your option contract is going to be at depending on the price move. So if Microsoft is trading at 170 and you're expecting or shooting for a move to 175 on Microsoft, and you're like, well, I have no idea what the value of my contracts are going to be once we get that move, you know, whether that moves tomorrow, the next day, a week from now, you need to be able to figure out how much your contracts are going to be worth percentage-wise, you know, dollar-wise. And that is most importantly so you can go about formulating your trading plan. There's a bunch of features when it comes to the Analyze tab, and I just use it the most basic way that works for me. I've really just figured this out on my own. I've never seen a video on how to use it. So I'm going to break it down in the most simplest form and show you how to use this feature, this tool that's really going to help you plan your trades, calculate, you know, your risk on these contracts and your reward, most importantly. So let's jump in. I've got the screen pulled up right here just so you kind of have an idea of what you're actually looking at. Okay, I've pulled up ticker symbol BAC. Currently BAC is trading at $38, as you can see. Again, this is under Analyze, and you're going to go to Risk Profile. So Analyze, Risk Profile, it's going to pull up this chart. This is all just standard. You know, I just left all this probability ITM. This doesn't matter, this number, this date. So this date is going to be the expiration of your contract. So whatever day your contract expires, you're going to have to change that date. I'm going to show you how we're going to go about adding a contract, and you can even add simulated contracts. So what I like to do is, and I'm going to cover this later on in the course, but this is going to give you some context. So when you get to that segment, you're going to have an idea for how I'm actually calculating my options. Before entering a trade, I'm going to add a simulated trade. That's after I've already picked out my option contract, strike price. You know, I've looked at the Greeks, I've done all that, I've got my contract that I would like. I'm going to go ahead and add a simulated trade. I'm going to input some numbers and make my calculations based on the numbers that this risk profile gives me. So it really helps you break down and in the most straightforward way, okay, tomorrow if we get, you know, this move 2 to 3%, whatever your calculation may be, whatever target you're shooting for, to the upside, to the downside, you want to use this so you know how much your option is going to be worth at that time when your target is hit. And going across the bottom, so we've got what is pretty much called a price slice. So you can see there's 3 different slices. You can go to this plus and add more slices. I only use 1 slice. I only ever buy, a call or a put. The slices give you the ability to work with more numbers and look at more contracts, but let's just keep it simple. I keep it simple. You can go ahead, delete all of the slices except 1, just keep 1 slice. So strike price, that is going to be the price at which you want to do your calculations for. So say you want to know how much your contracts are going to be worth when BAC is at $40. You're just going to change this to $40. But we've got no contracts up on here yet, so nothing's going to happen. But once we do, you can see that the P&L open and the P&L day, that is going to change. We've also got our Greeks, our theta. It helps you calculate everything. It's just such a great tool. And you can also grab this little orange slider, just move, to whatever price you would like. So say you want to get your calculations. If BAC is going to be at $41, you just move that to 41. So let's actually go ahead. You're going to go over to Add Simulated Trade. Click on Add Simulated Trade. Okay, we've got our contracts. Say we're going to go a month out. Today's the 20th. We'll go with the May 21st contracts. Click on that, and here we go. After you've gone about, choosing your contract, I'm just going to go with a random one. We'll just go 3 in the money. Go with this one, and there you go. You can see it's added to the bottom here. We've got our contracts. We're going to head back over to risk profile. Okay, risk profile. Now, say we want to buy, 5 contracts. Okay, and our price, we're going to buy them at $1.87. So it's already gone ahead. It knows how much they're worth live, right? This is just a simulated trade, but it gives you in the moment how much the contract's worth. Now, the contract's value is going to be going up and down. If you want, you can just go over to trade all products and you can, choose the same contract. Click on buy and it's going to pull up the contract. Market's closed right now. Contracts aren't going to be changing, but you can see it. Obviously, it said we were going to get filled at 187. So we're doing calculations for 187. If we were to get filled at 184, which we could right now if the market was open, right? Say 184, you can go back here, analyze, and just change this to 184, just to be a little more accurate. Now you can already see our P&L open and P&L day has changed, but what we're gonna do is we're working with the 21st of May contracts. So we're gonna go up here, click on the calendar, we're gonna go May 21st, okay? There we go. Now we've got our contract date input, and now we have to change the calculations. So when I say calculations, what day are we trying to get data from? Do we want to know tomorrow what these contracts are going to be worth? Do we want to know in 2 days, 3 days? And for the example of this video, let's just go a couple days out. We'll go with Thursday, so the 22nd. We can start dragging the slider. You can see those numbers are changing. Now, our current price of BAC, $38.08, and our target is $39.03. Okay, we enter here and we're shooting for $39.03. Back to analyze. We're going to go down to price slices, $39.03. Enter that. And you can see now on Thursday, if we get this expected move and we do hit our target at $39.03, our contracts are going to be up $315. So we will have made $315 on those contracts. It's incredible, right? We can see exactly how much we've made. So this is how I go about calculating my upside and my downside and how much I'm willing to lose. You always want to have a plan and know exactly how much you're willing to lose, you know, whatever percentage wise, dollar value wise, and have your stops in place. And that's something I'm going to go over once I set up my trade plan, which I'm covering later on. But the same applies to, you know, the downside. Say, well, the price moves against you and we get a move to the downside. Let's just say to our next support level. Now that's a very large drop. If I was in this play, I would never let my position bleed out that much, but $36.62. So we're gonna go analyze, and you can just drag this if you want. $36.62. So it's hard to be as accurate when you drag it. That's the only problem. Whatever, right around there. So you can see, well, if we ended up, you know, selling off and we got this move towards the downside and your stop was at 36.66 or whatever it may be, you're looking at a negative $413 move on these contracts. So you're going to be down $413. Your downside risk. Now, if you're putting your stop at 36.66, your downside risk is going to be $413 on these contracts, whereas your upside risk was going to be that previous, let's just say $39.05. $39.05. Your upside is going to be right around there. Your upside is going to be $345. So you can start calculating, okay, I'm risking whatever the total position size is, 5 contracts at $184 a contract. So say you have a $920 position size. Well, that means our max pain, right, as much as we want to lose or not want to lose, as much as we're willing to lose, where we have our stop set, is going to be, what was it, $400 something. And our max, you know, our profit, not max profit, but our profit on these contracts, our target is going to be, you know, $345 profit. Is that worth it for you? Is the risk, is the reward worth it? Maybe not, maybe it is. But this is just an example of how you go about kind of grasping this concept and this idea. It's important to realize that risk, reward, and position sizing, while it is one of the most important topics, it doesn't matter if you don't have a good strike rate or a high strike rate. You have to know your strike rate. So your, you know, say you take 10 trades, out of how many trades on average are right and how many are wrong? How many are winners and how many are losers? What is your win ratio? And then through that, you calculate whatever portfolio size you have, what position sizes you have, the percentage gain or loss you can take on those contracts to either break even or come out at a loss or a gain. Like, there's so much that goes into it, and those are all calculations that you're going to have to kind of work through on your own, but I will be covering that. So go ahead, watch that segment in the course, as that is a very important segment, and I'm not sure if it's going to be before or after this exactly, but it will have to do with like risk, reward, and how you actually go about calculating that depending on your strike rate. It's kind of a confusing topic and something that I struggled a lot to understand at first, and there's no one or no book or no video that told me like this is how you do it. It's just been a learning experience of figuring out what works and what doesn't, and coming up with my own formula. And you can, you know, use similar concepts and a similar idea, but you're not going to have the same strike rate as I do, so you're not going to be able to follow the exact formula. But it is something that, you know, people just overlook and you don't consider, and it's one of the most important things when it comes to like longevity as a trader, and the pure fact that you literally have to, win more than you lose over not a period of days or weeks or months, over years when you're doing this. I got kind of off track there. Anyway, I'm going to show you really quick how you can actually look at a current trade you have on a position. If you have an open position, you can apply that to this risk profile and do calculations as you go. So one of the positions I have open right now, and we're just going to go ahead and click the X, get rid of that. We don't need that anymore. I've got a position open on GM. So ticker symbol GM. Now all I'm going to do is just click on GM. As you can see, I've got a trade in progress, and I'm going to go ahead and click on Analyze and Risk Profile. As you can see, GM is already ticked, and we've got my contracts. I've got 6 contracts, and we can see what my value is going to be. But obviously, this is not right because we have to make our adjustments. Okay, so these contracts expire on May 21st. So we're going to go up here. We had May 21st before, but every time it resets, so you've got to readjust every time. Let's go with Friday this time. Now I want to see, what I'm trying to do is figure out what the value of my contracts will be Friday, depending on where the price of the stock is going to be at. So you kind of have to think backwards. Well, you have to look at the chart and figure out what your targets are, or let's just use, for example, my target. Now I've done my calculations, but I've done my calculations because I entered today for tomorrow. And at the end of tomorrow, if I don't end up closing this trade, I'll recalculate and do calculations for the next day. I like going a day at a time, but just for the example, I'm going to go Friday, so we're going like 3 days out. My take profit is at 57.19, so I'm going to go to Analyze. I'm going to click on the strike price. All right, 57.19. Sorry, I had to get some water there. I'm about 6 hours into recording this course, but you can see 57.19 is, our target. So there we go. We've got our calculations. We're taking about a $43 loss just because of theta. So, it lets us know our P&L open. We're at $1,002. So if we got a move to my target by Friday, on Friday, if we hit my target, my take profit, obviously right now with my current calculations, I'm looking at about a $520 gain. But if it happened Friday, we're actually looking at a $1,000 gain on these contracts. So, something to consider. Maybe I might even decide to adjust my plan, but it's good to know. And, this could go the other way. So let's say I end up hitting my stop at 54.95. Well, 54.95, we're looking at an $886 loss. So the gain might go up, but the loss goes up as well. Anyway, this tool is just incredible. It's a bummer if you don't have ThinkorSwim. I don't know if you would have even gotten to this point in the video if you don't, but if you do, please use this tool, and please, apply these calculations to your trading plan. And with that said, that is going to wrap up this segment. So watch it again if you have to, and I will see you in the next one.
As we wrap up the 4-hour masterclass, I did want to give you guys one last opportunity to join my mentorship group. Now, I've put a link in the description below. If you click on that link, you can learn more. You'll essentially have access to follow along, to copy my trades, to trade live with me every single morning, and a whole lot more. The link's below, and I hope to see you over there.
This is one of the most important topics when it comes to being a successful trader. Honestly, one of the biggest keys when it came to finding success for myself personally in the market. And I would say that almost every, if not every profitable trader has either done this or is continuing to do this. This is something you have to apply within your trading system to find success, to be able to become a profitable trader. It is a necessary, it is a must. You have to have a trade plan. Every time I enter a trade, any trade I've ever taken, I have made I would say it's a moderately in-depth trade plan. I know some traders go over the top and some go very conservative. But I've found a system as far as the trade plan that works for me. I encourage you to try out the same trade plan that I use, follow the same rubric, make adjustments, figure out what works for you. Again, nothing that I'm giving you in this entire course is something you can copy and paste. Everything you learn, you're gonna have to adjust and find what works for you specifically. I'm gonna go ahead and put a PDF below with the trade plan. You can take that out of the course, download it, and start applying it to your own trades. You want to know all of this ahead of time, and you want to have calculated out all of these dollar values, these percentages, and figure out exactly what numbers you're working with. Depending on what your strike rate is, you want to know what your general percentage target is so you can remain profitable over a series of losses. You want to take everything into consideration. I know I'm probably confusing you, so let me pull up my trading plan and show you kind of what I mean. So this is my trade plan. I never even entered this trade, okay? But I went through the motions of creating this trade plan, doing my calculations. So this trade was gonna be on ticker symbol AMAT. So I've got my ticker symbol, whatever it is I'm trading, and I've got the setup. You can see in here, the setup for this trade was a bounce off the 180-day SMA. So we don't need to be super specific. We're just trying to give a general idea of what the entry is, why we're entering. We're gonna work with some numbers. So like I said, I'm looking for a move back up to previous highs. Our margin for profit, I always make sure to be aware of what margin we're working with from previous highs. If the setup is a bounce off the 180-day SMA with the idea of working back up to previous highs. But depending on what setup this is, I might not say the margin of profit from previous highs. I might say the margin for profit to the 180-day SMA. So you have to, make adjustments depending on what the trade itself is. I want to be aware of our price levels. Where's our support? Where's our resistance? And you can see we've got support on the 15-day EMA, 180-day SMA. We've got levels at 132.89, 128.29. So, I'm aware if we're trading above the 15-day EMA that level could very well be acting as a support level, as well as the 180-day SMA if that is below where we're trading. And then I've gone ahead and I've figured out where our support and our resistance levels are. So we've got some support at $132.89. And then I've got this little arrow, and what this means is essentially 3.36% below this level, we have more support, and that is at $128.29. So our price, wherever we're sitting, we've got support, 15-day EMA, 180-day SMA, and then another 3.36% below that, we've got more support. So it's important to calculate the distance between your support levels and your resistance levels. And that is because later on, we're gonna use these levels to determine where we're gonna set our stop, our take profit, etc. And then you can see we've got resistance at the 50-day SMA, again at $136.89. Then we've got another 3.70% gap up to our next resistance at 141.94, and then we've got another just about 3% to our next resistance level at 146.35. So we're charting out our levels. We're becoming familiar with what percentage we're working with if the price was going to move up to this level, if it was going to move down, how much percent we would be either gaining or losing. Now you might use those percentages to calculate what the value of your option will be if we did get a move to that level. And then I want to write down my trade scenario. So the trade scenario, it's pretty basic. What I like to do is I do all my calculations as far as risk management for the next day. So say today is Wednesday, I'm going to have a Wednesday entry with a Thursday exit. That is my preferable move, and that is my risk management calculation. And then very, very important, if not the most important part of this trade plan, is our actual risk management. Okay, where are we putting our stop? Where are we putting our take profit? This number right here is where I'm going to be putting my stop. So after that, after you figure out where you're going to actually be putting that stop, or before, depending on, how you're going about making these calculations, you want to calculate how much you're willing to lose and then know exactly how much you're going to be down on those contracts or on that trade, on that position size that day. So to simplify, I've identified that my stop loss is going to be at $132.84. And my P&L open, I'm going to be down $400 on Wednesday. Essentially what this means is I'm going to have my stop loss set at $132, and at which if I hit that stop loss, I will be down negative $400. I've done these calculations on Wednesday. Okay. Maybe that's confusing. The calculations have been done assuming that I closed this trade on Thursday. So maybe it's more simple for you to just say Thursday, but I want to know when I went about making those calculations. So later on, as in tomorrow, Thursday, if I didn't hit my target, if I didn't hit my stop, if I didn't hit my take profit, I'll readjust and I'll make those corrections. And I'll just say I made those corrections on Thursday. And then I want to know where I'm taking profit. Okay, so I'm taking profit at $136.80, at which time I will be up $520 on these contracts. Again, calculations made on Wednesday. This is really the most important part about creating your trade plan. You want to know your upside potential and your downside risk, how much you're willing to lose and how much you're willing to make. Essentially, it's your risk to reward. How much are you going to make on this trade and how much are you willing to lose on this trade? So my upside potential is going to be 18% and my downside risk is going to be negative 13%. Well, how did I get that number? Let's assume I trade with $50,000. My average position size is going to be 5%. So say these contracts were, I believe, $770. That means that if I had 4 contracts, it would be $3,080 per contract. That means that I'm looking at about an 18% gain on that initial $3,080 investment if I was to hit my take profit on Thursday at $136.80, which would give me $520 profit. So 18% of $3,080 is around $520. So that is how I went about figuring out those numbers. Again, this is a rough estimate and these numbers are going to change. And like I said, you're going to have to adjust these numbers depending on whether you hit your target or not. So I know $520 isn't exactly 18%. It's more like 18% of $3,080 is $556 or something like that, around that. Or not 556, 554. But you're trying to be, as accurate as possible, but you don't need to be to the exact T. And you can see right here, I've said adjust dollar value end of Wednesday if neither target is hit. I'm actually going to change this. I had said Wednesday, but so I really want to adjust Thursday if neither target is hit. So I'm adjusting the dollar value end of Thursday if neither target is hit, right? So we're entering on Wednesday. Wednesday's our entry. We've done calculations for Wednesday. If you would like, you could say these calculations weren't done on Wednesday. These calculations were for Thursday. So considering we get this move on Thursday, well, there we go. We've done our calculations and we're going to be looking at, a negative $400 loss or a positive $520 profit if we hit our stop loss or a take profit on Thursday. That's probably an easier way to visually see and go about displaying this information for most of you guys, although you can do whatever works. Again, just do whatever works for you. Mess around with how you go about, saying different things, whatever makes the most sense for you. And then I'm going to have my position size. So this is important to understand that, especially if you're trading options, depending on the contract you choose, you're never going to be able to find that exact 5% value. So 5% of 50,000 is $2,500. So to find 4 or whatever, 5, 6 contracts, depending on how much the contracts cost, to find that exact $2,500 value, you're not normally ever going to be able to do that. You're either going to be a little below or a little above. So in this case, we're a little above. We're about $500 above, but we're trying to stay within 1% or 2% of that typical 5% position size. So that is my trade plan. I know you're probably very overwhelmed looking at this, trying to figure out how I got these numbers, but don't worry. By the end of this course, everything I'm hoping is going to come together, going to make sense once you see me actually go through a trade and make this trade plan live, not go over it after the fact. It's going to make more sense. I'm just trying to give some context now as to what you're going to be seeing later on when I make my trade plan and take you through one of my personal trades. Just a few side notes when it comes to, calculating your percentages for your stops, for your risk management. This is all going to vary depending on your position size, depending on your win rate or your strike rate. You're going to have your own numbers. Say you make 10 trades. You want to know out of every 10 trades, on average, how many are winners, how many are losers. And mathematically, so that over 10, 20, 30, 100 trades, you will come out profitable because you are going to have losers, but you can't let those losers go so far against you that it's going to take so many winners to recoup that loss. I'm going to be talking about this in another lesson, so don't worry, but I just want to give some context as to how I got these numbers and generally what you're going to be trying to do when you're creating this trade plan and when you're trying to figure out your own numbers. But with that said, I really hope you guys do understand the importance of having a trade plan. And this is going to help you not only plan your trades and be more confident, but this is going to take off so much stress when it comes to your actual trading. You'll already be confident. You've already got a plan. You don't need to change that plan. So there's nothing to worry about once you've entered the trade. Again, we're minimizing the amount of thinking we have to do once we've already entered, because once you've entered, you start becoming a little emotional. You can work on not becoming emotional. You never want to trade with emotion, but no matter what, there is going to be emotion underlying, when you're trading. You're always going to have a little emotion. So the trade plan does not only help, relieve some stress, but you are no longer going to be making decisions based on emotion because you've already made these decisions beforehand. If you don't do this, the odds of ever becoming a successful trader are very slim, okay? Don't fly by the seat of your pants. Don't just enter stuff to enter. Have a plan, stick to your plan, execute that plan. All right, I'm gonna be taking you guys through one of my trades from entry to exit. I'm gonna break down my process, setting up and formulating my trade plan, picking the contracts, and most importantly, how I found this setup. And I'm gonna walk you guys through the whole process and hopefully make some money on this trade. So this play is going to be on ticker symbol GM, which I previously covered. I talked about this within the setup segment. If you want to go watch that again, I went over this setup that I have identified. But just for a little recap, pattern I've identified using the 4-hour looking at ticker symbol GM is this very defined pullback right below the 180-day SMA. So you can see we've gotten these pullbacks several times. Haven't been able to hold right above the 180-day SMA. We've dropped just below, and then we've experienced this very large push. So you could see pullback into a very large push, pullback, three drops below the 180-day SMA. We're really warming up for another huge push, making higher highs, pullback. We've got one red candle, one green candle into another huge push, again making a new high, so higher highs. And then most recently we just experienced another sell-off, dropped below that 180-day SMA. We've got our one big red candle, and here you go, we are forming a second green candle just as we did right here. So with this move, we want to I'm gonna have to figure out, am I looking for a move up to the 180-day SMA, or am I gonna be looking for a very large move into an all-time high, again, following the same pattern of making higher highs? So I've waited today to see if we were able to formulate and form some support. So we were, as you can see, form support around $54.94, 95 cents. And we're already forming our second green candle. I've identified GM. I had found this scanning through, my watch list. I moved it from my potential stocks watch list to my close watch list, and then to my ready to trade watch list. So it's gone through the rounds, okay? And now I'm ready to take a position. I'm gonna pull up my trading plan. Now, every trade I enter, I make a very detailed or semi-detailed trading plan. I know some traders might go in way more detail than I do, but this has been what works for me. And if you want this trading plan, again, it is under the trading plan section within the course. You can just download the PDF and pretty much use the same trading plan I do. So our ticker symbol is going to be GM, okay? Our setup is going to be a break above. Now, here's what I'm looking for. I am considering the current market conditions. And with current market conditions, I'm looking for a quick pop of 2 to 3%, a quick in and out. Now, right now, the market has not been following through with a lot of these setups. They've not been breaking out. They've been failing to break out. Okay, we haven't been getting the runs that we were a few months ago, and it has become more difficult to make money, but not impossible. So considering this, I am just looking for a move back up to that 180-day SMA. I'm gonna actually throw this out of here for a second, just do a little calculation, a little percentage calculation here. So if we enter, right around here, a move up to the 180-day SMA would be about a 2.5% move. So we're gonna look at, our contracts, we're gonna figure that out, but 2.5% is a great target, okay? I'm very comfortable with that. I think this move, this is a very solid move, and that's a margin of profit that would be worth it for me to enter this play. If this would have been 2 months ago, I think I probably would have tried to hold this thing through that 180-day SMA. I think we would have almost certainly caught or been able to break above that level. But again, with current market conditions, I'm looking for a quick pop, 2 to 3%, and I'm getting out. So for my setup, I'm just looking for a move to the 180-day. So very straightforward. I'm going for a quick pop. It's important to modify the trading plan. This is just the base rubric I use. You can change it however you want. I'm just gonna say I'm going for a quick pop, and instead of having my margin for profit from previous highs, I don't need to know that, right? I could calculate that, but all I'm looking for this play is a move up to that 180-day SMA. So I want my margin for profit, instead of the previous highs, I want to be looking for my margin for profit from the 180-day SMA. Okay, go ahead and just draw this again. Try to be a little more accurate. So I'm shooting for a 2.4% move. Okay, so 2.4% is our target for our move. Our price levels. So our current support, we have support at 54.95. Okay. And now what I like to do, how I kind of format this, is we've got a move of, I'm going to calculate how far of a move we have to our support below that. So I'm trying to get an idea of our levels. When I start trying to plan this trade, I have to know our upside potential, our downside potential. So I'm going to try to get those numbers through, calculating the percentages between different levels. So we've got about roughly a 1, I would say a 2% downside if we were to lose this support. So it's important to know that. So 2%, that would set us at 53.9. So 53 6.9. Anything below this, I don't need to know. It wouldn't matter. But above, you know, we've gone ahead, we've calculated, you know, our move. We're looking for about a 2.4% move back up to that 180 day. Let me pull this up again. We've got resistance at the 180 day SMA. Again, we're aware of our other moving averages, so our 50 day and our 15 day, but those aren't going to play a role in this trade. They're way above, you know, where we're currently trading, so it doesn't matter. So the 180 day SMA is our resistance, and it's also our take profit. So that's where we're going to be taking profit at that level. Now for our trade scenario, we want to have a general idea of obviously when we're entering and when we're looking to preferably close that trade. Now our calculations that we're going to do shortly are going to be based around that day, and we'll have to adjust, you know, depending on what happens. If that's confusing, don't worry, I'll explain. Our trade scenario is going to be a Tuesday entry. Today's Tuesday with a Wednesday exit. So I look and I do my calculations based on a 1 day swing period. So that's my preferable move in my RM. So that's my risk management, which we're going to get to, is calculated based on that trade scenario. Okay. Now it's going to get a little more confusing here. We're going to have to calculate our percentages. Okay. Our stop loss, take profit, combined with our risk management, our strike rate. You have to consider all these things, right? A strike rate, your strike rate isn't going to matter if you don't have proper risk management and position sizing. Vice versa, if you have, you know, a poor strike rate or a low strike rate, then the position sizing and your risk management isn't going to matter. So everything works hand in hand. Now here's what we're going to do. To figure out our risk management, our take profit, our upside potential, our downside potential, we're going to go ahead and first pick out our contracts, how many contracts we're going to get, what contracts we're going to get, and then we're going to be able to figure out those numbers. All right, so let's go over to all products. So today is the 20th. So I'm going to go a little over a month out. I'll go with the May 21st. I'm going to apply our Greeks. You want to be aware of the Greeks. And I am going to go with what I typically like to do is go with contracts 3 to 4 spaces in the money. Okay. Obviously, in the money contracts are going to be safer for multiple reasons. Make sure to watch the options segment in the course if you need some clarification on that. Let's say we're going to go with the $53 strike price. Right now we could get filled at 440. So May 21st, $53 strike at 440. I'm going to head over to analyze. I'm going to go add simulated trade. And I'm going to try to work through a couple scenarios, and we might have to look at a couple different contracts depending on, you know, the numbers we're going to get. So May 21st, $53 strike price, and 440 is where we can get filled right now. Now, these numbers are going to change a little bit, but we've got to make these calculations. Yes, the market's still open, but we've got to do these calculations. Numbers are going to vary, and we want to go with pull our trading plan back up. My typical position size, pretty much standard with all my trades, is 5%. So I trade with a $50,000 portfolio. $2,500 is 5% of that. Considering we want to have a 5% position size, let's calculate the amount of contracts we're going to be able to buy. All right, so 6 contracts at $4.40 per contract is going to be $2,640, which is, you know, a little bit above 5%. So we could go a little bit under. Okay, so 5 contracts, we would be a little bit under. 6 contracts, we're going to be a little bit over. Gonna just keep it around that 5%. Again, the contract prices are going to vary, so you know we're never going to be able to hit that exact 5%. So position size is going to be a 5% roughly position size for $2,640, considering we got filled at $4.40. You're going to want to go ahead. We've got one splice. Okay, we've just got one splice right here. Now, this is where the calculations come in. This is where we're going to be figuring out our risk management, where we're going to put our stops, and our upside and our downside potential. And just a quick side note, the more you do this, you're gonna become better at this process. You can adjust this process. This is just what works for me. I like keeping things organized and having a very straightforward and easy to understand plan. Okay, back to active trader. So let's figure out where I'm going to want to put my stop loss and my take profit. Would like to aim for so I like playing around with numbers and percentages a bit. I'm looking for around a 20% profit on this trade. Take into consideration your strike rate, play around with your numbers. I'm gonna shoot for a 20, 25. I'm gonna go for a 20% profit. So let's do some calculations. Let's first calculate what that options value is going to be if we get our expected move to the 180-day SMA. I like to draw a little box. I feel like it keeps it pretty clean and neat. I'm going to go ahead and draw a line on our target right at the bottom of our box, okay? So 57.19 is our target. I'm gonna go back to analyze. I'm gonna go down to strike price. Now, I'm gonna make sure that I've adjusted these correctly. So I'm gonna change this to Wednesday. Okay, so the expected move, we're doing our calculations for tomorrow, which is Wednesday. And then I'm going to want to head up here as well. Now this is when the contracts expire. These expire on the 21st, so May 21st. And I'm going to change, this box to May 21st. There we go. We've got the May 21st contracts, $53 strike price at $4.40. Our calculations are going to be based on tomorrow, considering we get this move tomorrow. What are our numbers going to be looking like? And I said our target is $57.19. Type that in. And as you can see, there we go. This little line right here, it just did our calculation for us. And we're looking at a $520. Okay, it's going to change a little bit because the market's still open, price is changing. Around $500 P&L open. So our upside potential is going to be $520 if we get this move. Okay, so I'm going to pull my trade plan back up. So I'm going to make sure I write down my take profit. Okay, so you can see our take profit is at $57.19, and at that price, our P&L open on these contracts, assuming that we get this move tomorrow, Wednesday, is going to be $520. Now, considering my strike rate, this is going to be different for everyone. How many trades am I going to win out of every 10? I'm shooting for a 20% profit on this trade, okay? Now, 20% of 2,640 is $528, okay? So, $528 is almost on the T of, being exactly 20%. So our upside potential on this trade is going to be 20%. Our target is at $57.19. We're going to be looking at a $520 gain, considering we get this move into tomorrow on Wednesday. A little summary for myself, upside potential, we're going for a 2.4% move. The target is $57.19. And that target will put us right at the 180-day SMA, at which time we will take a $520 profit on those contracts. So now we've calculated our upside potential. Now it's time to go look at our support levels and calculate our downside potential. Also, I want to make a quick note that you have to be aware of, the Greeks within these contracts. For our contract specifically, we're going with the $53 strike price, for which theta is $4, negative $4. So every day we hold these contracts, it's going to cost us $4 per day to hold. We've got 6 contracts. Well, that's $24 a day to hold these contracts. Our downside, I'm going to do calculations for $54.95. This is going to vary wildly depending on your strike rate, but 22% is kind of as much as I want to risk on this trade. Anything more than that, currently with my strike rate. I'm gonna have to adjust my levels based on that. And you would think it would make more sense to have, well, more upside potential than downside potential, but all of that just comes down to the math behind your strike rate and your risk reward and your, position sizing. So typically look for more upside than downside, but it depends how you go about, formulating your trading strategy and your plans. And there's a bigger picture to look at than just your risk to reward. So we're sitting at about $453 for downside potential. If we did lose, this level tomorrow, just to see, let's go ahead and calculate for 53.91 so we can get an idea if that's a level we would ever want to put our stop at. And at 53.91, our downside potential is $815. That would be a downside of over 30%. I know that with my strike rate, with my win ratio, I cannot take a loss that big on these contracts, or it's going to throw off my numbers. So I'm going to set my targets for 54.95. This is going to be my stop loss at 54.95. Again, calculations for 54.95 would put us at negative $416. Again, this number's shifting because the price is still moving, but our stop loss, we're going to put at 54.95. That's going to put our P&L open at negative $430. If tomorrow we do get a sell-off, we have our stop loss set at 54.95. We know our max loss we're willing to take on this trade. That is also going to help you, relieve a lot of the stress when it comes to trading, knowing these things ahead of time and planning this ahead of time. All right, so $430 is about 16% of our total position size, which is $2,640. So negative 16% is our downside risk. Percentage-wise, we're looking at about a negative 2% drop to hit our target. Now, I'm keeping this stop pretty tight due to the overall market condition. Just the fact that the market has been trading in a range and we have been failing to break out. And so it's better to cut your losers right away and don't ever let a small loss turn into a big loss. All right, a little summary. We're looking at about a negative 1.80% stop set at 54.95, support to cut loss with a $430 loss if we do hit that target. And I said adjust, dollar value end of Wednesday if neither target is hit. So we're going to have to adjust these numbers if we don't get, the upside or the downside move and we don't hit our targets tomorrow. We will have to make calculations and adjust these percentages and these numbers. But our take profit and our stop loss is going to remain the same, but the value of the contracts are going to change. But we've got 2 minutes left. I like to wait until the last second or the last minute of market open to place my orders. Now, all of our calculations are going to shift a little bit. They will, they will be a little different depending on where we get filled, what price we get filled at. So right now we can actually get filled a little lower. So I'm going to go ahead, take advantage of that, get filled about $5 lower on those contracts. So already, there we go. We got filled. Our upside potential is looking even better in this scenario, as we've just saved a little bit of money on those contracts by just waiting until the last minute the market is open. Some people get stressed out waiting until the last 40 seconds to enter a trade, but that's why if you've planned your trade and you've done your calculations, and there's nothing to stress about. So all right, there goes the bell. So I'm going to go ahead and put GM under my open positions, keeping things nice and organized. There we go. And I'm going to go ahead and add some text to my targets. All right, so our stop loss, visually, I like to be able to see this in a second, just know what my target is and where the levels are at. So stop loss, we're looking to take a negative $430 loss on these contracts if we do break below that 54.95. All right, we've got our take profit, 57.19 for $520 profit. What I'm going to do right now is go ahead and set alerts, create an alert at or above, drop it down a little bit just so I get a little heads up. And then I'm going to set alerts as well for our stop, and at or below, bring this up a little bit so we get a heads up. All right, so we've entered our trade. We've got our trade plan, a very solid trade plan. We've done our calculations. All right, we know our price levels. We've got the trade scenario, risk management. We've calculated our upside potential, our downside. We know exactly how much we're willing to lose on these contracts, where we're cutting losses. We know exactly how much we're gonna make and where we're gonna take profit. So now that we have planned the entirety of this trade out, there's nothing to stress about, and there's going to be no last minute decisions and no reacting on emotion because we've already planned out this trade. Now, this is one of the most important things, and I've seen a lot of new traders and traders in general literally just fly by the seat of their pants with no plan and wonder why they're down, why they're not doing well, and why they're not able to find consistency in the market. And it's simply because they don't have a plan. I'm excited to see what happens. I'm going to keep you guys updated on this position. I might end up holding this a couple days. We might close tomorrow if our targets are hit. All right, that is how you make a solid trade plan and enter a position. All right, good morning, team. What is up? I hope you guys are all having an amazing day. Today is the next morning. So right now, as you can see, I'm just doing a little update on my ticker symbol GM play, and market this morning on open sold off a bit. You can see we dipped right to our stop, but was able to recover, was able to hold above that level. Didn't end up losing that level. Sometimes it's important to give whatever it is you're trading a couple more minutes. Once it hits your stop, see if it really is going to go lower or if we're going to catch a bounce on the stop, right? That support is still acting as support until it's been invalidated. So yes, we hit our stop because the whole market, the market as a whole was selling off, but we got a nice bounce. So looking at it now, we're actually up about 1.15% on the day. And we're working our way up to that upper target. So very clean play. So far, we are up about 200, or it just fluctuated, but $199, $215 around that on this position. So going well so far on GM. Again, working our way up to our target at 57.19. So great play so far. And I'm going to be checking back in later. So I just closed ticker symbol GM. And I'm so frustrated because the audio did not record. I have the recording, and you can see right here, if I move my face, well, here I am closing ticker symbol GM. So that's all right. I'm going to walk you through what happened. I'm just going to replay my screen recording and just voice over what I was kind of saying. So if it's kind of weird or delayed, that's why. But you can see I'm in the bottom here and I'm talking, but unfortunately, I was not recording my audio. But I'm going to play this video and I'm going to walk you through what happened. So alerts went off on ticker symbol GM. We ended up hitting our target at 57.19. This was a beautiful move. We got through the morning, and this is the next day. So we got literally the textbook move. We're up $529 so far. So now it is time for me to go ahead and close this position. So I'm going to go create closing order, and I'm going to sell these contracts and lock in profit on this play. We're going to get filled, at 520 as high as we can. We're going to go confirm and send. Try to get filled, and you can see we just got filled. So that was really everything that goes into one of my plays, from initially finding GM, doing technical analysis, and moving this down my watch list from potential stocks to close watch to ready to trade to setting up our trade plan, doing our calculations. I've taken you guys through the entire process, my entire system, and we got a nice move this morning, hit our target, and as you can see in the screen recording, just closed this position for $547 profit. So that $520 profit was my target. So we ended up making a little more money than we even had planned on. So such a great play. I am really excited that I was able to record this for you guys. So I'm gonna go ahead and pause the video, but that is my system for making trades. And that is how I go about formulating a trade plan, finding my stock. And that is really essentially how I trade and how I've been able to find so much success in the market. And it is important to note that these numbers, my stop loss and my take profit, those are numbers you're going to have to figure out on your own, depending on your portfolio and your strike rate and your risk management, your position sizing. Those are things you will have to adjust. But the general system of how I go about entering and managing a trade, setting up my trade plan, that is all something that you can follow. You might have to make adjustments, but in general, you could follow and do the same thing that I have just done.
Thank you guys for watching this video. Don't forget to subscribe. I'm actually posting daily on the YouTube channel here, so you can tune in every single day. You can see how my trading and progress is going. Smash a like if you did take away any value. And again, the link is in the description below to my mentorship group.